This is an insurance rate cut. It doesn't really foreshadow what's going to happen going forward.
This is all about risk management.
This is a Fed that locked arms. One dissent was surprising.
It's really clear that Powell corralled the cats.
We're all kind of hot and bothered by this move, but the truth of the matter is we're not in neutral territory yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday with low conviction.
A challenging situation, two-sided risk. There's no risk-free path. It's not incredibly obvious what to do. A risk management cut, a meeting-by-meeting situation.
Fed Chair Jay Powell attempted to unite a divided Federal Reserve as rate cut projections fall well short of very high expectations. Newly minted Governor Stephen Miron might be offering a preview of things to come.
All right, let's just go over what he did. Yesterday, he did dissent, saying that he opted for a 50 basis point rate cut rather than a 25 basis point rate cut. He indicated with his dot, and yes, we all know that it's his dot, that he sees going forward a 125 basis point reduction in Fed funds rates this year.
Might be Chair Powell's dot.
Right, exactly. Absolutely no, that could not. What was interesting to me was actually not what Stephen Miron did. It was what Mickey Bowman and Chris Waller did not do. They didn't join that dissent, and that, I think, was more telling to markets after a moment of digestion than anything else.
Look, the dot plot was a contradictory mess. I think the forecasts were a contradictory mess, and that compromises the chairman's ability to articulate a clear message. But that just speaks to how divided this committee is, which speaks to the overall theme anyway coming into this. Would we get risk management rate cuts, or would it be the beginning of a big easing cycle? When you have a committee as divided as this one, it's got to be the former and not the latter.
Yeah, and what does the market do with a complete lack of forward guidance and a complete lack of understanding of what the reaction function is going to be because of this divide on the FOMC? And the answer is buy stocks. I mean, that's sort of what people do, and buy stocks that are rate sensitive, because there is this bet that ultimately this is clearly a committee that is prioritizing growth over inflation. It has been that case for a number of years now. It seems like there is absolutely no reason why it should change.
You know, I joke about it being the Fed chair's dot. It might be the Fed chair's dot in 12 months' time.
Oh, well, that's true. Okay, very good point.
Something you have to think about.
You know what was interesting? If you look at some of the betting markets, the chance of Stephen Miron being the next Fed chair went from 11% to 20% after this meeting. So clearly there are some people who see that probably the president over in the UK liked what he saw.
We'll spend some time talking about this, no doubt, through the next 3 hours. Equity futures, Bramo talked about it. Buy stocks, buying stocks, up by 0.8% on the S&P 500. Coming up this hour, Julian Emanuel of Evercore, with stocks rising after the Fed's first cut of the year. We'll catch up with Everett Eissenstat, the former NEC deputy director, as President Donald Trump prepares for a meeting with Keir Starmer, and Francis Donald of RBC, with Powell pushing back against an aggressive cutting cycle. We begin this hour with stocks rising after the Fed cut rates for the first time this year. Julian Emanuel of Evercore ISI writing, the Fed's projections support the president that stocks move higher on a 12-month forward basis when the Fed begins the cutting cycle. We reiterate our year-end 2026 S&P target of 7750. Julian joins us now for more. Julian, good morning.
Good morning.
You've been writing about it. Is the Fed cutting because they can or because they have to? Why is that an important distinction?
Because if they're cutting because they have to, i.e. fighting off the potential of a recession, the forward returns look markedly different, much weaker on average, because there is an adverse economic set of circumstances that you're having to guard against. But look, when you think about not necessarily the knee-jerk yesterday afternoon, but certainly what we're seeing this morning, there's two messages, is that the market does believe, as the Fed talked about yesterday, that we are approaching the trough of economic growth and are going to reaccelerate, however gently, in 2026, and the peak of inflation. So if you think about the last couple of years, it hasn't been the absolute level of either growth or inflation. It's been the direction of travel. And that's where, the virtuous cycle lies.
From the conversations you've been having with clients at the moment, do you sense that something has flipped? Are they more concerned about upside risk than they are downside risk?
This week, the dynamic changed. Look, we were managing money back in the late 1990s. And frankly, as the technology revolution, the internet revolution was evolving, active managers couldn't keep up with the indexes because they couldn't own enough technology. The conversation now is, what do I own? What do I buy? How do I stay invested if we are, in fact, beginning a runaway phase? Our answer is you need to stay with the AI theme. It is the theme that has brought us to this point over the last couple of years. History tells you that what has been working, what had been the market leaders, despite the fact that there's a lot of catch-up being played, tends to work in the later stages as well. But frankly, if you've got that kind of outperformance, you might want to buy a little bit of protection because the parabolic advance does have pullbacks. We also think that low valuation stocks, lower multiple stocks with high earnings revisions also tend to work.
Well, this is the reason why I think a lot of people are going into the Russell 2000. People looking at small caps that are seeing earnings growth and seeing that they'll benefit more disproportionately, potentially, from the rate cuts. And it's the reason why yesterday, and I understand it was one day, you did see that rotation out of the big tech, the high flyers, into some of the more rate-sensitive stocks. Do you think that that's a persistent theme? Or do you think that ultimately it really is going to be a tech-driven cycle, period, the end?
Well, if you think about the late 1990s, and we've said this a number of times, and frankly, where we started really coalescing around the parallels between the late 1990s and today was not in the relentless advance, but that bear market interruption we had from February to April, very much like 1998. The point there is at the later stages, all the boats rose, okay, but technology continued to lead. And what I would say here is if you look at it, what's different now versus then is, in fact, the advanced decline line continues to rise as the index rises, whereas in the late 1990s, it was only those later stages where everything else began to participate. So there is a health here. Ultimately, we think, particularly with regard to small caps, that the best thing that happened yesterday is that the 10-year yield remains anchored near 4%.
That's where I wanted to go. I feel like nervous Nelly. I feel like I'm always kind of repeating myself. What about inflation? And what about the worry about bond vigilantes coming back? And everyone kind of shuts me down and says, haha, that's cute. It's not actually going to happen. It hasn't happened. And frankly, we've seen the peak in inflation. Isn't that a little bit of a creeping concern at some point? If you're running the economy hot, we're talking about a reacceleration. Can we be sure that inflation truly has peaked?
It's definitely a concern. And if you look at the last number of months, again, there's been this angst around the fact that inflation has looked like it was getting sticky. But, the fact is he didn't use the word transitory, but he did use the word one-time price adjustment yesterday. And the presumption is that tariffs are a one-time price adjustment, and you're going to have inflation start to move lower again.
You're not impressed, Bramo? The 2-year view of inflation getting back to target, the rolling 2-year view of the Federal Reserve.
Okay, first of all, he said a million things. Half of it was word salad. He was asked questions that were tangible questions about the 2 years, and he was like, well, targets, inflation, next. It was not necessarily this clear concept of exactly where they were heading, first of all.
Sure.
Second of all, it's not just tariffs. It's also this idea that there are production lines that are being moved back to the U.S. What about all those stories? There are all of these inflationary stories that people just forget at times when it's convenient, bring back when it's time to go with the trend, and I'm a little bit frustrated by that.
Their inability to get back to 2 predates April 2nd.
Exactly.
It's an important point to make, and I agree with you.
Well, and especially if you have a changing demographic, if you have an aging population and they've got more disposable income because they're the boomers that have houses that they got with cheap mortgages and they have the assets from the S&P 500.
You haven't slept, have you? Keep this up. I'm loving it.
Are you speaking from personal
Go after
experience?
those boomers this morning. Why are the houses so expensive?
No, I'm just saying, like, they could invest in services and it'll bid prices up. Okay, carry on.
I'm right there with you. Can we go back to the 90s? Let's go back to the 90s. Houses were cheaper then. In the late 90s, I want to reflect on your experience of that. Was career risk greater if you missed the upside or missed the downside?
Not even close. The penalty for missing runaway bull markets is almost invariably more severe than being overinvested in the downside.
How conditioned is a generation of investors by that very fact, that experience?
Well, what the interesting thing is, you go back to earlier this year, it's not the generation of professional investors that are conditioned. The public is actually learning from all of this, okay? Remember, March and April, when professionals were de-risking, it was the public that was buying the dip. And frankly, that's part of the narrative, along with the 4% 10-year yield, that supports multiples at these levels.
This is a controversial question, but has the Fed become less relevant and not necessarily a political instrument, but a market-related instrument? And the market has confidence that when push comes to shove, this is a central bank that will always underwrite risk over the fear of inflation running a little bit too hot.
Well, again, and forgive me for doting on the 90s again, but the difference being, once again, is that if you look at the late 1990s, in 1999, the Fed raised 175 basis points in the second half of 1999 to try and pop what was an inflating bubble. There is no set of circumstances in our mind that is going to cause the Fed to raise rates at any time in 2026, certainly not before the midterm elections. And in that respect, there is further support for equity markets.
There's a degree of comfort, I think, for a lot of people, Lisa, that now inflation is closer to 3. I know it's nowhere near 2, but closer to 3. This Fed appears to be more comfortable supporting the labour market. And if we are to get further weakness, this Fed will keep cutting interest rates. That's the way Chairman Powell has ultimately set things up. If there is consensus around anything on the committee right now, it's essentially that.
Yeah, it's to prioritize the labor market over the idea of getting inflation at 2% anytime soon. When Michael McKee asked Chair Powell about the 2-year kind of rolling goal of getting down to 2%, Chair Powell said, well, that's our models. We do a 2-year looking out and we try to understand, and that's where we think we're going to get there. And then he moved on.
He said the quiet bit out loud, didn't he?
He did, which is essentially that's what we expect. And when it doesn't happen, we keep expecting it.
The magic forecast.
Exactly. And at a certain point, people say, all right, well, this is the reality.
We've got some time to think this through this morning.
I'm sure everyone's pleased about that.
But when I woke up, I was thinking, you know what? Everyone's throwing mud at Governor Myron's dot. And we pointed out yesterday, for an important reason, you've got to remember that could be the view of things at the very top of the Federal Reserve a year out. That could be a taste of things to come, point one. But there's a second point. What if Governor Myron's right? What if that is where rates end the year? And I was thinking about it. This Federal Reserve is hopeless at turning points. Go back to the SCP and look at the median dot of late 21. And they were forecasting interest rates 12 months later at 0.9%. They were several hundred basis points off where they ended the year. In fact, if you want a more recent experience, go to the SCP and the dot plot of June last year. Just June last year. They weren't forecasting the 100 basis points of cuts they ultimately delivered into year end. So I think you sort of have to respect the people who are willing to think outside the box, and don't just sit here and say this is politics and condition yourself to ignore it just because of that. Clearly there's some politics here, but acknowledge that this Fed is absolutely hopeless at turning points and think about a wider range of outcomes over the next 12 months.
So I'm looking at the dots, and the dots talk to that wider range of outcomes, with the high dot around 4% and the low dot around 250 over the longer period of time. The turning point, I think, is a key one. Are we turning into an era that is deflationary or reinflationary? And that, I think, is indeterminate. And I think that that's what the Fed is struggling with.
We can spend some time on this, Julian. You're going to stick with us, I'm happy to say. Julian Emanuel of Evercore. Equities up by 0.9% on the S&P. With an update on news worldwide with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. China's Huawei unveiled a plan to challenge NVIDIA's dominance in the AI chip market. The company unveiled its new SuperPod cluster designs that can link more than 15,000 of its Ascend AI chips together to boost computing power. Huawei plans to roll out the new models in 2027 and 2028. Shares of Alphabet rising in the pre-market. The Financial Times reported China is dropping its antitrust investigation into the dominance of Google's Android. The announcement comes ahead of Friday's scheduled call between President Donald Trump and China's Xi Jinping. Walt Disney's ABC network is taking Jimmy Kimmel Live off the air indefinitely. The announcement comes amid a backlash over the late-night host's comments about the killing of Republican activist Charlie Kirk. On Monday, Kimmel suggested in his monologue that the MAGA movement was looking to score political points off the death of Kirk. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. More from Vonnie in about 30 minutes' time. Up next on the programme, from pomp to politics.
The bond of kinship and identity between America and the United Kingdom is priceless and eternal. It's irreplaceable and unbreakable.
Up next on the programme, we'll get to the business end of the state visit. We'll catch up with Annmarie on the ground in the UK. From New York City this morning, good morning. Chairman Powell, it's challenging to know what to do. There are no risk-free paths from here. So what do you do the day after a very challenging meeting? You buy stocks, up by 0.9% on the S&P, on the Nasdaq up by 1 full percentage point, on the Russell up by 1.5. In the bond market, yields lower across the board, unwinding yesterday's move. Twos, Bramo, back down to 352.
This is clearly a Federal Reserve that's going to cut rates, maybe not as much as previously expected. And actually, you did see Fed funds futures increase the potential rate at the end of 2026. That said, the idea that this Fed is going to cut, despite the elevated inflation rate, has been locked into the market psyche. And this is a Fed that is clearly underwriting risk assets.
Should we lighten the mood and move away from the Federal Reserve for a moment?
Was that dark?
Just for a beat.
Okay, sure.
Something more exciting, some theatre. Under surveillance this morning, from pomp to politics.
We're joined by history and fate, and by love and language. We're like two notes in one chord, each beautiful on its own, but really meant to be played together. The bond of kinship and identity between America and the United Kingdom is priceless and eternal. It's irreplaceable and unbreakable.
Is there anything more British than that scene right there?
I mean, that's what I said to you. I was looking at this and I was thinking to myself, you could have taken this out of a Hollywood movie and known exactly where it was, the exact mood, the mood music, and then you pointed out for 0.0001% of the British population. But that is sort of how we think about the UK.
I've said this a few times, whatever your politics, I can't think of a single person that enjoys being the president much more than the president of the United States, Donald Trump. Is there anyone that enjoys this more than him?
This is his second visit at a time when this is, already a fraught visit when it comes to some of the tariff rates and the politics around it. And yet this, I think, is what he aspires for the new ballroom to look like in the White House.
I don't think you're far wrong. Let's put it that way. If you're just joining us, welcome to the programme. Here's the latest this morning. President Donald Trump praising the long-standing relationship with the United Kingdom. The president joined by a long list of guests, also expected to attend a business reception later on this morning. On the ground, following things is Bloomberg's Annmarie. AMH, talk us through what happened in the last 24 hours, and let's get to the business end too, what we can expect throughout this morning.
Well, the president himself has called Windsor Castle the ultimate setting, and you can see the pictures yesterday. Absolutely picturesque. Hollywood, to Lisa's point, maybe meets Hogwarts in terms of what we actually saw take place at this state banquet. The president was leaning into this special relationship, talking about how it's two notes of one chord, beautiful separately, but they should be played together. And we should note the royal family really went above and beyond to make this incredibly personal for the president. Even they included a 1912 cognac to represent the birth year of his Scottish-born mother. But that special relationship is going to get a little bit more tense today. Keir Starmer, the Prime Minister, will be hosting President Trump at Chequers. They are there right now together. They're going to have this business reception, which is going to be welcomed by both of these men, especially given the fact that a lot of those faces we saw last night, like Mark Benioff, Sam Altman, Tim Cook, are going to be at that reception. Jensen Huang, who this week said he declared the UK will be an AI superpower, that's going to be the easy part. Then when it comes to the press conference, this is where the special relationship can get tense. There could be questions on trade, which those discussions we have assumed and we are told really are being shelved right now. The UK wanted to push for lower tariff barriers on steel. We know that geopolitics is going to be front and center because the Times is reporting that once President Trump leaves this weekend, Keir Starmer will formally recognize Palestine as a state. And then an awkward moment potentially about Jeffrey Epstein. Headlines that dominate with the president back home in Washington are also a problem right now for the prime minister, given the fact that he just ousted his British ambassador to the U.S. because of close ties to that man. So it's going to be during the press conference where all the happiness and the close bond, the kinship of last night could be evaporated. Annmarie,
appreciate the update. We'll touch base with you in the next 60 minutes or so. Still with us around the table, the chief equity strategist at Evercore. We've got Julian Emanuel with us. Julian, I want to talk about the trade story that Annmarie alluded to. This market has moved on. It feels like years ago, even though it was only 5-6 months ago that April 2nd happened. This Federal Reserve is prepared to look through the consequences of the trade war too. Are you prepared just to move on, to forget about it?
Well, factually, what we're seeing is what we've seen over the course of the last decade plus, is that both corporate America and consumers are adaptable. We're really, we're managing through the tariffs. There's, been some pass-through. Again, that's the whole idea of the one-time adjustment higher. But there's also been, the flow-through in terms of margins which remain elevated. And then, of course, suppliers bearing a part of the cost. We do think it's part of the message of inflation and growth being where they are right now. But when you look a year from now, that effect is likely dissipating.
How much are we overlooking the retail sales? And clearly that weighed on the Fed's decision, and the reason perhaps that Mickey Bowman and Chris Waller didn't dissent with 50 basis points. I keep thinking about what Mohamed El-Arian said about how after the pandemic, a lot of retailers removed those stickers that said $1.99 suggested retail price. Those no longer exist on any of the packages because they see prices as more fungible and consumers as more adaptable to higher prices. How much does that change the way that tariffs will be passed through in the economy versus, say, 2018, when they weren't as widespread and when people were more conditioned to almost zero inflation?
Well, it all comes back to what it always comes back to, given the structure of the U.S. economy, the importance and the health of the consumer. Right. And that's why, again, when you think about the message yesterday, there is some uncertainty around what the labor market dynamics actually are. What is the correct number for monthly job ads now, given the change in immigration policy? It might have been 120,000. Last year, it may only be 60,000 now. But the point being, again, is that, and it's been said a million times, don't underestimate the consumer's propensity to spend in this country, and that's what we're seeing.
You seem pretty comfortable. On a scale from, say, hiding in a bunker to raging bull, where do you stand?
Look, we're telling people that you should actually think about hedging here against a core structural long AI portfolio, because frankly, the sort of 10 to 15% pullbacks that were part of the late 1990s, you're going to get one in here at some point, and there is a huge amount of good news that's been priced in, and you are really approaching all-time high multiples. Multiples alone don't kill the market. It's really more recession and rates that do. But bigger picture, we do expect a period of what I would term FOMO, accompanied by a much more robust capital market cycle that, if you think about it, there's been pent-up demand for transactions for over a year now.
How bullish is Julian? This was the title of the note that I got overnight from Julian Emanuel. Nowhere to go but up. That was the subject title of the research piece released overnight. Nowhere to go but up.
Yeah, this sounds like raging bull, but Julian, being a disciplined analyst, is saying you've got to hedge. And I guess I'm thinking to myself, hedge but don't sell. And that, I think, is the key. Hedge and find ways to maybe offset any type of downside, but don't get rid of those stocks because they're going to keep on going up. And this seems to be what everyone thinks. When there's confusion, just buy stocks.
He also knows how to get us to open an email too, doesn't he? That works. It's effective.
Fair.
Julian, it's good to see you.
Great to be
Thanks
here.
for spending some time with us. We appreciate it. Julian Emanuel there of Evercore. Equities at the moment higher by 0.8% on the S&P 500, bouncing back big time so far this morning. Rally in the bond market as well. So big rally in stocks and bonds to start Thursday morning. Coming up next on the programme, we'll catch up with the former NEC Deputy Director, Everett Eissenstat, on continued trade talks happening between the UK and the United States across the pond, between the President of the United States, Donald Trump, and the Prime Minister, Keir Starmer. Plus, we'll get you some morning movers. We'll touch base with you higher up. Google, jumping on news coming out of China. The latest on that in just a moment. That stock is higher by 1.4%. A very mild two-day losing streak on the S&P 500. We're taking that back and some so far this morning. Higher by 0.8% on the S&P, on the Nasdaq up 1%, on the Russell up by 1.5%, and that has been the story outperformance of small caps ever since early August, when we first got that very weak July payrolls report and we started to bake in some serious Fed rate cuts, even with the Federal Reserve failing to meet very lofty market expectations. This rally resumes in the bond market, 2-year. Big range yesterday at the front end of the curve, 9 basis point trading range. The 2-year down again this morning by 3 basis points. Again, taking back the move of yesterday, 352.37. This is where we're anchored at the moment, Bramo, at the front end of the curve. It's really settled around this kind of number, 350.
Yeah, people seem to be coalescing around the idea of 5 to 6 rate cuts by the end of next year, maybe taking off one of those after not seeing a dissent from other members other than Stephen Myron. That said, I think there's a real question of how long this can really help the Russell 2000, how long this can keep propping up stocks until we get an answer to some of the very big economic questions the Fed certainly cannot resolve.
Which makes it really difficult to internalize the message, if there was a message coming from the Federal Reserve yesterday. Key takeaway is front-end yields are 40 basis points lower than they were at the end of July, and small caps are a whole lot higher. 3 hours away from the opening bell, let's get you some morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. We start with Alphabet. Shares are popping 1.3% on an FT report that Beijing is scrapping its antitrust probe into Android. And the timing does not feel like an accident, with President Trump and President Xi Jinping set to speak tomorrow on the phone. So this is being viewed as Beijing extending an olive branch, yet Beijing's recent crackdown on NVIDIA, which have ramped up in recent days, is calling into question how meaningful that olive branch really is. Meanwhile, we have some deal news in the pharma space, and it has to do with the red-hot obesity market. 89bio is soaring 83% after Roche agreed to buy the U.S. biotech in a deal worth as much as $3.5 billion as Roche seeks to catch up in this booming space. And this company, 89bio, has a treatment tied to that. So Roche is paying up and paying up big with an 80% premium to yesterday's closing price, which is right in line with where we're trading at today, John. Meanwhile, we are learning more about the fallout from the Cracker Barrel controversy, where it unveiled a logo change and quickly had to reverse after some backlash. Shares are falling nearly 10% here after the restaurant chain posted a disappointing sales outlook. It said that since the uproar back in August, foot traffic has dropped about 8%, and it will continue to be down for the rest of the year, just showing you how swift and aggressive the backlash can be when you hit one of these cultural and political nerves. John?
Yahara, appreciate it. Thank you. More from Yahara in the next 60 minutes or so. On a radar this morning, President Donald Trump and King Charles dining at Windsor Castle with some of the biggest names in tech. Apple's Tim Cook, Nvidia's Jensen Huang, and OpenAI's Sam Altman among those at a state dinner last night. Elsewhere, Alphabet rising in the pre-market. The Financial Times reporting China is dropping its antitrust investigation into Google's Android. The decision coming ahead of Friday's call between President Trump and China's Xi Jinping. And finally, China's Huawei is turning up the competition on Nvidia, the company unveiling its new SuperPod AI chip, expected to link thousands of other chips together to boost computing power.
Yeah, this actually makes me think a lot of what we discussed with Vivek Arya of Bank of America yesterday, where he was saying that certainly China wants to compete, and certainly they are very good when it comes to a lot of the hardware. The issue for them is the software. And can they understand the development? Can they expedite that and the ecosystem around some of this hardware to really match the United States? It goes to this question of how easy is it for China to truly surpass the United States in AI capabilities without the use of the likes of NVIDIA and other U.S. champions?
Respective governments are trying to choose winners and pick national champions. And it's very clear that NVIDIA in China is going to be in a more difficult spot in years to come, based on the very fact that the Chinese Communist Party wants Huawei to succeed more than it does NVIDIA. And you can see that based on the communication we've had, the reports we've seen from the team over in Asia repeatedly, that the Chinese government is pushing these companies to pursue Huawei's technology and not NVIDIA's.
I just wonder long term, when we look back, and I apologize for being philosophical, maybe I didn't get that much sleep last night. Will this be viewed as a good thing? The idea of trying to pick state champions to be the leaders in the tech universe. Does that lead to good business decisions and good technological decisions? Or is it short-sighted, the idea that Huawei could make these super chips, the idea of bundling together for superpower, without the development of software that can really adapt it in some sort of concrete way and disseminate it? If that's the case, can they really catch up, or are they throwing good money after bad? And equally in the United States, if you end up saying to the likes of some of the big tech companies, you have to make this, that, and the other investment, is that going to be positive for them down the road? That, I think, is what a lot of investors have to get their heads around.
We're both capitalists. We don't like central planning. Then we should say that up front.
I think everyone could tell.
But this is the reality of national security issues. The president talks about his relationship with Xi Jinping, and it's obviously for diplomatic purposes. These two countries are not friends. And they both face the same risk. China is aware that any given time, the president can turn off the supply of American technology to China. And I think also the American government is well aware that the same thing can happen to them, particularly if Taiwan is compromised, and that we need to build out domestic foundry capacity in America. That's the direction of travel. The question I have at the moment is whether, if you're a multinational company, say NVIDIA, can you take advantage of both markets? At the moment, maybe, but for how much longer? They're the questions I'm thinking about for the future.
I think it's a question a lot of people are thinking about, and I think that Jensen Huang is trying to play the ultimate diplomat, but at a certain point, like so many others, you may be forced to choose.
Got to pick a side, maybe, potentially. The stock is up this morning by 2.4%. Let's turn to trade. President Donald Trump meeting with UK Prime Minister Keir Starmer before concluding his second state visit today. Everett Eissenstat, the partner at Squire, Patton, Boggs, writing, the UK government rolled out the red carpet for President Trump. The atmosphere certainly points to stronger bilateral trade relations, including in trade and investment. The former Deputy Director of the NEC joins us now for more. Everett, welcome to the programme, sir. Always good to hear from you. They've rolled out the red carpet. What's it achieved?
Well, so far it's given everything. I mean, the setup for this negotiation today is really well done. The president's in a very good place. He's excited about the visit. He's enjoyed his time there. They're on with some of the greatest innovators from the United States are sharing the stage. It's a good environment, and I think that can bode well for the discussion. Now, it doesn't mean that everything's going to land in place, but it certainly sets a warm environment that I think makes the type of negotiations, the type of issues they're going to discuss easier to manage and easier to resolve.
Everett, do you get a sense that the United Kingdom, given this special relationship, will actually achieve some sort of carve-out for steel, carve-out from other tariffs that are creating a lot of difficulty right now politically for that nation?
I don't think any particular country is going to get a full carve-out. However, I do think that the United Kingdom's probably going to get one of the best deals out of any country thus far. They've already set the stage for a good framework. They've got better terms of trade than a number of other countries. I think the first mover advantage they had back in May made a difference. They're building on that. And one of the interesting dynamics here is that this second discussion on trade is really part of an ongoing dialogue that's been transpiring ever since that framework agreement was reached. And that's an important point because these dialogues are going to continue to evolve. They provide a lot of opportunity for expanding issues, including things that will be discussed, such as digital services tax and other irritants that we still have. So they're great framework agreements, and they put a good framework for continued discussion.
There's also this question of who is with the president right now, a whole lot of tech leaders from the United States. And I'm sure you were just listening to John and I rant about the potential for capitalism to become something of state planning, but really the very legitimate, as John was pointing out, national security concerns. What do you think from an economic and political standpoint, which you've held both hats, of this idea of the tech leaders being the commensurate diplomats, and for this to be a tool of both international outreach and national security?
It is absolutely fascinating. I did listen to your conversation. I agreed with much and most of what you said. The fusion of national security and technology, and it's here to stay, as is the relationship of business to government. Now, it's going to be different in different economies, but we're seeing more and more of that power of the United States being projected by the leaders that we have in the tech world. And there's a lot at stake here. There's a lot of issues they want to get resolved in the international trading environment. The fact that when you go with the president on a state visit like this as a corporate executive or a CEO, it's a pretty magnificent opportunity to have your issues front and center. And it sends a really strong message that this matters. And this is something that we really need to work through.
Everett, how seriously should we take the kind of announcements we've heard from certain tech firms about investing in places like the UK? Is that theatre too, or is that actually the real deal?
Oh, I think it's the real deal. I mean, I think and in fact, it's almost like soft diplomacy from the private sector, because they're coming with gifts, right? They're saying, if you can help us create an environment that enables our industry to thrive, we will invest in your country. And that was one of the reasons that so many countries enter into trade agreements with the United States, because they're able to put their economy in a place that attracts investment. So they're sending a very strong message. There's some things they'd like to see changed in the way that the UK government approaches digital services. And they're willing to put their money down. I think it's very real, and it could be a long-term trend that we see perhaps with other economies as well.
Everett Eissenstat with his view on what's developing in the UK. Everett, thank you, sir. The former NEC Deputy Director. If it's real, is it achievable? We've talked a lot about the energy requirements for some of the announcements we've heard over the last week.
I was actually just looking up UK energy prices, spot prices over time, and I'm trying to track it to really understand exactly what you're talking about. This is true around the world, but especially so in the United Kingdom. And you just wonder whether you can achieve some of these lofty goals. Given the political backdrop, cost of living crisis, demands for people to bring down the cost of living, and the idea that energy prices in the UK have risen quite a bit over the past.
If you want a real-time price check, just call my mum. I'll hand you the phone. I get an update often.
Yeah,
expensive.
Is that bad? I'm so sorry. Yeah, he can pay. That's right.
He is.
Yeah,
Don't worry about it. He is. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Tesla says it's working on a redesign of its door handles. The announcement follows a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. Earlier this week, the National Transportation Highway Safety Administration opened an investigation into whether some Tesla doors are defective. Meta has launched the first version of its smart glasses with a built-in screen. The $799 Ray-Ban display features a screen in the right lens that can show text messages, video calls, directions and maps, and visual results from web searches. Meta CEO Mark Zuckerberg says the product will be a vehicle for what he calls AI superintelligence. Starbucks employees in 3 states filed a class action lawsuit against the coffee giant. The filing claims the company violated the law when it changed its dress code but refused to reimburse employees who had to buy new clothes. Starbucks' new dress code of a solid black shirt under their green aprons went into effect May 12th. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. You're finding it difficult to censor yourself this morning, aren't you?
Well, for a lot of reasons. But I think that the idea that it is difficult and you're going to sue over buying a black T-shirt, I'm just struggling with that a little bit.
Why do you think ultimately they are? And should the response be that Starbucks isn't paying them enough to go out and buy their own uniforms?
That might be the reason, or it could be the idea of individuality and the idea of
expressing yourself.
Yeah, because
the
that
cliche
was a big issue of the Starbucks and the individual expression and some of the other messaging in some of the stores. And this could be a signal that if you want us to be uniform, you have to compensate us appropriately for that aspect. I don't know. But I'm assuming that has more
I'm
to
right
do
there with you now.
than just simply, a black T-shirt.
I'm a little bit slow this morning.
Well, I'm a little bit, slappy. So there we go.
Meeting you in the middle. Up next on the program, risk mitigation.
With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. You could think of this in a way as a risk management cut.
Up next, Francis Donald of RBC. From New York City, you're watching Bloomberg TV. Equity futures on the S&P 500. There is a lift here this morning, up by 0.8%. A range of views following the Federal Reserve. This from Neil Dutter of Renmac. If today's move was primarily about risk management, I think there is a risk that the Fed can fall behind on their employment mandate later. So many different views. Some people think their pursuit of 2% is incredible on the inflation side. Other people think they're falling well behind on the employment side.
Yeah, and Neil put out a note yesterday saying, remember Occam's razor, the idea that if it looks like a duck and it quacks like a duck, it is a duck. And there is this idea that maybe if you see weakness in the overlying numbers for the payrolls report, there is true weakness. And that currently is a concern, but right now it's not felt in markets.
We've certainly seen some weakness, that's for sure. Under surveillance this morning, risk mitigation.
Risks to inflation are tilted to the upside and risks to employment to the downside. a challenging situation. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. You could think of this in a way as a risk management cut.
So here's the latest this morning. The Federal Reserve cutting rates for the first time this year, highlighting downside risk to the labour market. Frances Donald of RBC joins us now for more. Frances, good morning.
Good morning.
What's your assessment to what took place yesterday?
I know we've probably said it 100 times since then, but this line, there are no risk-free paths ahead, it kept me up all night because I kept thinking, this isn't just about the Fed, this is also about the path for the economy. And everything I heard yesterday felt very much like a symptom of what we're experiencing in the U.S. economy, as opposed to what we're usually looking at, which is the Fed leading what happens next. And when we look at U.S. growth right now, it is true, there are no clear win paths ahead for the U.S. Either we're going to see tariffs flow through to consumers and see that higher inflation path, or it's going to result in businesses needing to cut costs, and that's further job losses. Neither of those paths are great. Maybe there's a muddle through in the middle. So there's no clear path for the Federal Reserve, but there's also no clear path for the U.S. economy, some symmetry between what Chair Powell said and what's happening in reality.
Do you think Chairman Powell has revealed a preference, a risk he's willing to take?
Of course they've revealed a preference. I remember 6-9 months ago, we started talking about stagflation light. What will the Fed do with the dual mandate intention? They've now told us very explicitly, a little bit of a wobble in the labor market. They are showing up to the party with the punch bowl, no question. And I'm going to push back a little bit against Chair Powell, if I may, and say, listen, we haven't had great job creation, but that unemployment rate's still very, very low. None of us know the true break-even rate for jobs in the United States. So we're at the very beginning, in my opinion, of seeing some labor market weakness, but we are also in the very beginning of seeing inflation heat up into year end. This Federal Reserve is going to be cutting rates into inflation reaccelerating in the United States economy, and that reveals their preferences very clearly.
As an economist, how much signal did you get from Stephen Myron, given his role, given his position with the president, given the fact that the Fed chair's position will be open early next year? Did you give it more weight, or did it give you less weight? Or did you give it less weight when you considered that Chris Waller and Mickey Bowman did not join him?
Well, look, the number one theme I talk to my clients about is the significant fragmentation that is happening into the United States economy, that there are haves and have-nots. There are regions that are doing really well, and there are regions that are suffering. People that are doing really well, people that are suffering at the same time. And so when I look at that dot plot and the divergence within it, it again mirrors what's happening in the real economy, which is a divergence of realities and a divergence of perceptions of where we need to go next. So this divergence theme, I think it's going to continue no matter who's in their positions, because these Fed members, they're looking at different segments of the economy. They have different responsibilities for different regions. We should see divergence in that dot plot if we have folks who are focused on different elements of the U.S. economy.
I don't ask this flippantly, but is monetary policy broken? And I say this when you look at forward guidance that kind of means nothing. You look at the potential rates that the Fed has control over, and they affect some parts of the economy, but clearly not others in any sort of meaningful way in terms of slowing the economy or heating it back up. It just raises the question, how much efficacy has Fed policy lost?
Well, my outside voice would probably say something like, oh, the transmission mechanism is weakening. But my inside voice tells me, hey, we've moved from monetary policy dominance to fiscal policy dominance. And I'm more concerned about what is the path for government going to look like? What's going to happen to that long end of the curve? And most importantly, when I look at this economy, we have 25 basis points in. 25 basis points is not going to solve what ails the American economy. 100 basis points is not going to solve what ails the American economy. It's like taking ibuprofen for a broken arm. It'll take the edge off, but the real problem facing America right now is a 1 in 100-year trade shock that is going to weigh on investment, it's going to weigh on job creation, and it's going to increase prices.
So then why are people buying stocks and convinced that inflation is going to come down?
Well, it depends where you're looking, because this, again, a fragmentation, that trade shock creating a lot of fragmentation between trade sectors and not. And let's not forget, we're at this strange nexus where we have these big structural themes that are overtaking the cyclical. We talk a lot about AI as one of those structural themes dominating over the cyclical, but we also have huge government that puts a floor under growth. Really mechanically hard to get a recession when you have governments that are this big, huge retirees, demographic shifts, and 1 in 3 jobs in America is either government, healthcare, or social assistance. 20% of incomes in America are government transfers coming through. So we don't have that same sort of cyclicality that we had in the past. This is an economy that's less interest rate sensitive. It's less business cycle sensitive on a go forward. Does that mean it's broken? Well, maybe this is just a different type of economy and we need new tools to look at it. Hearing Chair Powell yesterday wrestle with how to communicate was really just another symptom to me that economists are having to grapple with a new economy, new tools, and new ways to forecast.
I'm picking up two things from you, and I think this is a fantastic experience for the both of us getting this original insight on how you view the labour market and inflation. That perhaps, one, the payrolls reports we've seen overstate some of the weakness elsewhere in the labour market, and two, you keep returning to the fact that you expect inflation to pick up. Now, the chairman has essentially said it could be the kind of inflation the committee can look through. Would you push back against that too?
100%. Now, I accept goods inflation. Let's just take that. There's tariffs. They're one-offs, as they say. Although, just a little asterisk on that. That's a little more complicated because the tariffs moved up and down. They spread. It's not clear what products they're on, et cetera. But look under the hood at services inflation. Services inflation is still an issue. In our estimate, there's different estimates. We have OER remaining sticky and we have wages remaining relatively sticky, a floor under that. So even if you take out goods, and even before tariffs are coming through, we were concerned that the Fed would not get back to 2% inflation in 2025 and into 2026. And just optically getting above 3%, our forecast is 3.4% by the early 2026. Optically, it's real hard to do that. But they can, John. They can use any measure. Remember, Supercore. Fed can come up with all sorts of, we're going to take this, X this. If they want to ease, they can do it. They're going to have to be very convincing to markets, though.
Was it the Cleveland trimmed mean? Remember playing around with that too?
I've played around with so many things, and then finally I just go to gas prices, and that's essentially my metric.
People's real experience of what's happening.
I mean, that, or you can go to eggs, or you can go to chicken, or you can go to blackberries.
Francis, you alluded to this too. You expect to see it in early 26. That's soon. Is this going to become apparent to more and more people in the months to come?
Early 2026 to mid 2026, and we map out when we think tariffs are going to start to be impactful. I do not believe that if tariffs were going to show up in the price data that they would already be here. We need to see significant inventory drawdowns. They are different by sector, so you have to look at each individual sector to get a sense of that. And then companies have to make decisions, and those aren't happening in real time. So early 2026 to mid 2026, before I'll feel comfortable sitting with the two of you and saying this was the impact of tariffs on the economy.
Yeah, credit to you too. I think it's important for people who haven't been following your research and some of the commentary that you've had when you've come on this programme. This isn't a mark-to-market call. You've been talking about this for a while. You're going to have to wait. This is the process we've been discussing, not a one-off event. Wait, it's going to happen in the months to come.
What Francis just discussed to me was so refreshing. You are correct. The idea of a very different economy, that you have to use new tools to analyze, and how difficult it is to really look at past experience and pass it through to now, given all of the different cycles that seem to be superimposed on top of one another.
Chairman Powell's term ends as Fed chair in May, and there's all this speculation of him hanging around and keeping his seat as a governor on the board. Based on how difficult things are right now, I'd be looking forward to retirement, wouldn't you? Just May. I'm getting out of there.
I ask you, would you enjoy getting up every month or every 8 times a year and doing that press conference?
If I had Chairman Powell's personal balance sheet and a kind of money that I could command for speeches on the circuit after all of this, I'd be long gone.
I imagine it's pretty stressful. Yeah, I imagine it's not an easy job.
I would be long gone. Francis, it's good to see you. Francis Donald of RBC. Up next on the programme, Gargi Chaudhuri of BlackRock, John Lieber of Eurasia Group, Kit Juckes of SocGen, and the former Kansas City Fed President Esther George, the second hour of Bloomberg Surveillance. Up next.
There's a lot of tension between the inflation outlook and the labor market outlook.
I'm not that concerned about inflation.
There's a risk to the dual mandate if you pursue the maximum employment and you put the inflation at risk.
They are cutting rates into that environment.
And at the end of the day, you cannot get full employment sustained unless you really derail inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and it starts with some breaking news. We've got some things to get through. This headline just crossing the Bloomberg terminal, NVIDIA to buy $5 billion in an Intel stake as part of a new partnership.
This is a fascinating move, given the fact that these are longtime arch rivals, and Intel has been really struggling. Ideas potentially of the U.S. getting involved in this agreement. NVIDIA is going to own less than a 5% stake, buying common stock at about a 6.5% discount to Wednesday's closing price. And this really is a question of how much the U.S. is going to really underwrite Intel's effort to be a foundry and some sort of competitor to TSMC. To your point earlier, this idea of self-reliance in an uncertain international world.
Intel up 13% in the pre-market. Nvidia up by 2.5%. Let's head down to Washington, D.C. to get you an update and get your reaction from the UK as well, where Jensen Huang of Nvidia is on the ground in the United Kingdom. Our team coverage starts right now with Annmarie and Tyler Kendall. Tyler, first to you. A big headline crossing the Bloomberg terminal.
A big headline, quite the headline, John, for two companies that the U.S. government has a vested interest in. In a statement, we heard from the NVIDIA CEO Jensen Huang, who called this a historic collaboration. As part of the deal, Intel is going to use NVIDIA graphic technology in upcoming PC chips, and NVIDIA will use some of Intel's processors in order to meet the demand from AI data centers. The idea here being that they're really going to work together when it comes to some of this chip development. And it follows, of course, a recent push from this administration to bolster the domestic chip supply chain. Of course, last month, President Trump signing that deal that gave the U.S. government a 10% stake in Intel in a bid to sort of repurpose some of the existing CHIPS Act money. And I'll also point out that Japan's SoftBank made a surprise $2 billion investment in the company last month, too, amid this mounting pressure from the administration for this sort of money to be put up in order to clinch these trade deals. Now, I do want to point out one pretty important stat from this story that's now on the terminal. Analysts estimate that at some point next year, NVIDIA will pull in more revenue per quarter than Intel gets in a year. Of course, John, as you well know, this White House, this president has really shored up ties with NVIDIA as the company now finds itself really at the center of some of these sensitive trade negotiations.
Lisa, this is a really important development. You just listened to what Tyler was talking about there and the president's involvement in all of this. What's his objective? Build out domestic foundry capacity. One. What needs to happen after that? Someone needs to use it. And we've been talking about this over the last month. Who would be pushed to use it? This is not about the push anymore. NVIDIA essentially is telling you they're ready to use it. They're ready to partner with Intel to make this happen.
Yeah, and specifically on certain chips for PCs and other devices. The question is whether this is going to be a big effort or whether this is going to be more performative. And this is something that we've asked when it comes to China and the Huawei move earlier. This idea of, is the technology comparable? Or is it going to be tough to move away from, say, TSMC and Taiwan for the U.S. chip manufacturers?
Intel, higher again, up by 18% in the pre-market. Annmarie on the ground in the UK. Annmarie, I imagine this announcement is music to the ears of the president.
Absolutely. The president has almost become, a co-CEO of Intel, putting a lot of pressure, one can imagine, on a lot of these companies since, as Tyler mentioned, almost 1 month ago to the day, the U.S. government decided to take that 10% stake in Intel. And the question, Jonathan, you, me, and Lisa sat around the table and asked, who is going to be next to either buy these chips from Intel or invest in more money to make sure that Intel could once again become a national champion? So on one front, you once again have what many would maybe call unconventional, what the U.S. government did. But certainly this is going to mean that more support could be flowing into the company like Intel. And then to Lisa's point, what did we hear today out of Huawei, out of Beijing? This highlights a core issue for the United States. Huawei basically announced a multi-year plan to take on the dominance NVIDIA has in the marketplace. Howard Lutnick, the Commerce Secretary, has said time and time again, we have to make these chips in the United States. We have to make sure we are a dominant player in this. We cannot lose to China. Jensen Huang told me himself he doesn't feel like China's behind. They're right up against them in terms of where they are in the market and in AI technology. And the Commerce Secretary has said we have to make these chips in the U.S. We can't rely on Taiwan. So from a national security perspective, this really is in line in something we've seen from this White House. And once again, highlights, I would be absolutely shocked if the president and his team had no influence on this, highlights the heavy hand they are really taking in the semiconductor industry.
Annmarie, with the latest alongside Tyler, to the both of you, thank you. A big move for Intel in the pre-market, higher by 19%. NVIDIA up too by 2.3%. The headline just crossing 5 minutes ago. NVIDIA taking a $5 billion stake in Intel as part of a new partnership. Some other news crossing as well from the Bank of England. I'm going to squeeze that in for you. So rates are unchanged on Threadneedle Street in the City of London. They've kept those interest rates at 4%, but as expected, they've slowed the pace of QT to £70 billion. The estimate indeed was 70 billion. The interesting adjustment as well that's taken place here, they'll sell fewer long-term gilts than other maturities, long-dated bonds to account for about 20% of sales from here. So we've got a tech story and we've got a bond market story too.
Yeah, and I wonder how much long-term this is going to be connected. But just sticking on the bond story, the idea of the adjusting of the balance sheet, the adjusting of just how their central bank is going to deal with the issuance and the lack of demand for long-term rates is something that's a story playing out across the world.
Let's park the bond market story. Let's just sit on NVIDIA. What a story this emerged with Intel. First the government partnership, and now NVIDIA, the champion of the whole sector, arguably of the whole equity market, giving them an endorsement and the support that they might need to succeed in the future.
As an investor, how do you invest around this? Is this more the idea of having faith that the U.S. government and potentially other tech companies will do whatever it takes to support Intel, even if they make missteps? I mean, this stock is up before this move today, almost 24% so far this year. Although it's been struggling for a number of different years, but how much is this faith that there is so much interest in making this a national champion and a foundry that tech companies in the U.S. can use that it's very difficult to bet against them? How much is that something, as an investor, you can move against?
Gargi Chaudhuri of BlackRock joins us around the table. Gargi, good morning.
Good morning.
I know we won't address single names, but I do want to understand the concentration risk around some of these stories. How much of the fate of this market is in the hands of just one name, one CEO, one story?
Sure. Good morning. Good to be here. So this is exactly the theme that we write about in our fall investment directions that we wrote in early September, still very relevant now. And the theme that we highlight there is, we all grew up in the markets hearing the old fable of don't fight the Fed. Now it's don't fight the Fed and don't fight the AI trade, because that is what is going to drive sectors, and it's what's going to drive the overall performance of the index. Yes, due to some of the names very much being a part of the broader index, but those few names, the top 10 names, are also where the majority of the earnings growth is coming from. And while we read these headlines, I think we shouldn't lose sight of that fact that if you look at year-to-date returns, 75% or so have come from, of the total returns have come from earnings. And when we see these headlines and we recognize what the future of an Intel and NVIDIA is going to do, I think what it points to is further earnings growth just driving the S&P higher. So keep AI as a core theme in your equity portfolio. But I think more and more we're recognizing that you're going to have to do it in an active manner, because there's certainly going to be names that are going to be losers within this AI race and winners in as well.
How are you active in management, given the potential for political overlays to the tech story, as we've seen from the U.S. and from China?
What I mean by how one can be active is obviously thinking about certain sectors or certain stocks themselves that can not be as much of a beneficiary. And we actually saw that around this earnings season, right? We saw some software names that are not able to use AI as much as one would have thought, as much as expectations were, and are absolutely losing. And then obviously you have more of the hyperscalers as well as the chip manufacturers that are very much able to participate. So that is the active management. Obviously, in our fall investment directions, we talk about doing that through an iShares active ticker, BAI. But investors can also do it with, broad large cap ETFs. They can do it through broad large growth ETFs versus moving away from small caps, which has been our theme for the year.
Okay, that is exactly where I wanted to go. This idea of don't fight the Fed and don't fight the AI theme. Are they in conflict? And this is the way that they were yesterday. The idea that people saw this is an opportunity to go out of some of the high flyers and the expensive stocks and into small caps that were less highly valued. And you saw that rotation yesterday. You think that's a head fake based on what you just said? Why?
I think so. So I think that we obviously saw August as a great month for small caps. And then as September came around, we've seen that fading just a little bit. Historically, we've looked at periods where small caps have outperformed the large caps in more than 300 to 500 basis points. It hasn't really been able to be very sustainable. And partly it's the growth story. In small caps, you just don't have that earnings growth. But broadly, we all know what's happening. I think Francis was talking about it earlier in terms of the economy is changing and the rules that led to our investment thesis last decade will not work now. Many companies are staying private for so much longer that companies, when they finally go public, as we can see, the size of IPOs going from about 300 to 500 million to over $1 billion, they're now no longer small cap companies. So the market is shifting. You have also from a macro perspective, rates are still higher than the sort of zero regime that we were in for a very long time, and you don't have the earnings growth. So I think we can see certain short-term movements, and I think we've seen investors play that via options on things like IWM. Absolutely do that, but this is not a sustainable theme. Come back to large cap, come back to growth, come back to AI.
Come back home. There's a massive difference between what is driving the Fed and what is driving the equity market, public markets. What's driving the Fed is payrolls growth. And what's driving the equity market, the S&P 500, the capex intentions of a handful of companies. And that's been a long-term story now.
And the capex that is geared at creating technology to make humans more efficient, potentially to replace some of the functionality of humans, which is in direct conflict with the idea of job creation. A lot of people will push back and say, actually, it will just make our jobs better and enhance them and actually create other jobs. And like every tech revolution, which I am open to. But this is sort of the conflict, the difficulty in understanding the Fed's reaction function to that sort of seismic structural change.
Intel, by the way, still climbing, high by almost 30% in the pre-market. Unbelievable. Gargi, good to see you.
Good to be here.
Didn't expect that breaking news. Thanks for dropping by. Gargi Chaudhuri there of BlackRock on the market. Let's give you an update on that story with NVIDIA and Intel and a whole lot more with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Yes, recapping that breaking news we got just a few minutes ago, NVIDIA investing $5 billion in Intel. The company said they will co-develop chips for PCs and data centers. NVIDIA will buy Intel common stock at $23.28 per share. That's a 6.5% discount to Wednesday's closing price. The Bank of England holding rates steady at 4% amid growing concerns about a resurgence in inflation. The bank kept its guidance and warned that future cuts will be, quote, gradual and careful and dependent on the extent to which underlying disinflationary pressures continue to ease. And shares of Cracker Barrel plunging in the pre-market after the company's sales guidance missed expectations. The weaker than expected outlook comes as the restaurant chain is dealing with the fallout from its controversial and short-lived logo change. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, a priceless partnership.
The bond of kinship and identity between America and the United Kingdom is priceless and eternal. It's irreplaceable and unbreakable.
We'll talk about an old partnership, the UK and the US, and a new partnership, Intel and NVIDIA. Up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning. Breaking news just moments ago, 16 minutes ago, and this is the outcome. Up 33% for Intel in the pre-market. NVIDIA agreeing to invest $5 billion in Intel and saying the two will co-develop chips for PCs and data centers.
And this comes after the U.S. already discussing taking a stake in Intel. Those shares already up more than 20% so far this year, largely on the heels of that government intervention. Is Jensen Huang now part of the government sort of intervention for Intel? Is that what partly is behind this?
Okay, so I think you're framing this in the right way and you're going in the right direction. Is this a partnership between Jensen Huang and Intel, or Jensen Huang and the White House?
Exactly. This, to me, underscores whether this is actually a real partnership that will be a more widespread production hub of Intel for the likes of NVIDIA going forward, whether it can be a competitor to the likes of the Taiwan Semiconductor Company, or if this is performative to try to say, look, yes, Mr. President, I am supporting the domestic push for independence.
Under surveillance this morning, a priceless partnership.
We're joined by history and fate, and by love and language. We're like two notes in one chord, each beautiful on its own, but really meant to be played together. The bond of kinship and identity between America and the United Kingdom is priceless and eternal. It's irreplaceable and unbreakable.
The president reflecting on an old partnership between the United Kingdom and the United States. Later on today, at a reception with top tech executives, he can reflect on a new one, a new partnership between Intel and the NVIDIA CEO, Jensen Huang. Joining us now on the ground in the UK is Bloomberg's Annmarie. Annmarie, we've been talking about it. You helped break the news. Is this a relationship between Jensen Huang and Intel, or Jensen Huang and the president?
Well, John, it certainly seems like this is a relationship between Jensen Huang and President Donald Trump. Jensen Huang has been a consistent presence in this White House alongside the president throughout this entire second term. Remember, it was Jensen Huang that was in the Middle East with the president, and then he continuously called out. Jensen Huang was his friend, but his other friend, Tim Cook, decided not to come. Well, who was here on his UK state visit? Jensen Huang, of course, who this week in the United Kingdom said that he is going to be marking this week as the week the AI became, the UK became an AI powerhouse, and also Tim Cook. What CEOs are starting to realize is you need to have that access to power in this administration. And it does seem like we don't have full reporting yet. We have not heard a comment yet from the White House. But when the U.S. government a month ago to the day took a 10% stake in Intel, you pretty much saw that Donald Trump was going to be the Intel co-CEO, ultimate salesman, probably was going to go around, talk to other tech companies and say, what can we do to make sure we save this business and more companies are buying chips from Intel and we build up this national champions? And that seems to what is being done right now if you connect all of these dots. And it's not going to be lost on anyone. The president comes out in 30 minutes time at this business reception where Jensen Huang is likely going to be sitting. He's going to want to talk about this kind of collaboration in the semiconductor industry, which we've seen a massive heavy hand from the president himself get involved in.
Annmarie, thank you. That stock is flying. Intel higher by 29% so far this morning. To extend the conversation, John Lieber of Eurasia Group joins us now for more. John, I'm sure you've been tracking the breaking news of the last 20 minutes or so. How are you reflecting on this new era of statecraft led by the president, Donald Trump?
Yeah, I mean, the U.S. is in its state capitalism era right now. And I think that Donald Trump is doing these deals and he's pressuring companies because he wants to create national champions. There's a lot of concern about the competition between the United States and China in the AI space and semiconductors. And Trump hasn't been shy about cajoling and even bullying CEOs to get what he wants. And the CEOs see a tremendous opportunity to partner with the United States government and get access to capital and get these diplomatic visits that are going to result in tens of billions of dollars in new investments in the United Kingdom, which of course itself has a diplomatic overlay as well because of the U.S.'s growing hostility to the regulatory environment in the European Union. And so part of this trip is about bringing the UK a little bit closer and announcing that this partnership with U.S. businesses is much stronger in order to send a signal to the Europeans that, the environment really matters if you want to attract U.S. investment and U.S. partnership.
What's the precedent for you, John, that really matters when it comes to looking at the U.S. trying to support national champions for national security reasons for an entire industry?
I'm not sure there is a precedent like this. I mean, you think about the aerospace industry, I guess, during the Cold War and the emergence of a number of the large prime contractors, defense contractors that the U.S. deals with. There's probably other examples as well that I'm not as familiar with. I think this era is truly unprecedented, though, given the speed of tech acceleration, the dominance of these companies in the marketplace, and of course, the ongoing threat from China, which isn't stopping its own innovative path and is going to eventually have technology that competes with the U.S. toe-to-toe. And I think that's a major concern of policymakers, and they see it coming, and that's one of the reasons there's so much support going into this industry right now.
John, maybe I'm going too far down a rabbit hole, but one of the obstacles for the United States to really compete when it comes to a foundry, the actual manufacturing of a chip, has been training. There is an entire ecosystem in Taiwan around training workers to specifically be able to do pretty highly skilled jobs to make these really advanced chips. I'm just wondering, is there any appetite in Congress to come up with training programs or training incentives to try to create the workforce to really meet the moment in the United States?
Yeah, worker training is something that Congress has been trying to get right for decades, and I think they haven't quite got it right yet. There's a lot of support for community colleges or technical training programs or apprenticeship programs like they have in Germany, but the U.S. is such a big, messy place that it hasn't really gotten that together. And I think it's important that you mention these bottlenecks, which are, of course, a challenge for the administration across the board. You've got energy, you've got labor, you've got talent. And it's also notable that I think that it's hard to really see a coherent strategy here from the White House when one part of the administration doesn't know what the other part is doing. You look at the raid on Hyundai last week, and this was driven by DHS agents who were looking for a big bust, and that was directly antithetical to this idea that you'd want to attract foreign investment and build some of these high-tech manufacturing plants. This is going to be a problem in the semiconductor industry as well, because of exactly what you said. The U.S. lacks the talent and needs the migrants coming in to do so. So I think over time, we'll see the U.S. get that policy mix right. And I think that but because of the lack of training, you're going to see a continued reliance on foreign workers.
John, I'm pleased you said that. It's going to take time, and we have to give it time and space. But do you think there will be long-lasting consequences of that raid on Hyundai?
Yeah, I mean, this raid was a top story in Korea and South Korea, and you had workers who were deported from the United States for doing absolutely nothing wrong. And I think this was seen as a major breach of trust by the South Korean government. I thought it was notable that in the Truth Social post Trump put up, he basically apologized. He didn't say the words "I'm sorry," but he more or less apologized to the South Koreans for having deported hundreds of them. And I think that this is an issue of trust when looking at the United States. If I'm the Japanese, looking at the investment accelerator that was recently announced, if I'm the South Koreans, if I'm the Europeans, I think there's an issue of trust that you can't really rely on the U.S. to follow through on its promises. And that's going to be hard and of course, the U.S. market is massive. There's billions of dollars at stake. And these countries and these companies want to be inside the U.S., but it's very difficult to trust the administration right now.
John Lieber of Eurasia Group. John, thanks for jumping on and reacting to that breaking news. Intel in the pre-market higher by more than 28%. Nvidia up 2%. Nvidia higher by more than 3%. Wouldn't you love to be at that banquet today, just to hear that conversation between the president and the Nvidia boss?
I've actually been looking up different royalty movies from the 1800s in Britain to see what the parallel is to some of those scenes and what the women have to wear. Although the attire for the women is somewhat different than the men. The white tie, the white bow tie, and the cummerbund and all that.
I'm not really cut from that cloth, so I wouldn't know.
Well, I wouldn't per se. I'm just looking at that and thinking I'd probably be more interested in that. Just trying to wrap my head around how to fit into that than I would the conversations. I don't know how much actual stuff gets done at a meeting.
I imagine the president already knew anyway. I'm not sure this is going to be. Not sure this is going to be a new development for him. We're watching this come together in real time. This new era of statecraft. Mistakes can happen. This can get messy, I know, but this is the direction of travel being driven by this White House.
So who's next? And I think that that's the key question. Which tech giant is next to commit in some capacity to using Intel as a foundry? And can they do that with Intel pulling up its resources in tandem to meet the moment? And that, I think, has been the capability question that we've been asking, not just for the U.S., but also for China.
What does NVIDIA get in return? Does this open the door to certain chips being exported to China?
Great question.
These are things we've got to talk about.
Good for that.
We'll talk about that. Kit Juckes, the SocGen's going to join us shortly, and we'll get you some movers. The big mover in the pre-market, Intel, absolutely flying. Equities flying up by 0.8% this morning on the S&P 500, up by more than 1% on the Nasdaq, up by 1.5% on the Russell. It's only one story in town, though, in the last 30 minutes or so. So let's get to your morning movers. Let's touch base with Yahira for more. Hey, Yahira.
Exactly, John. We are seeing a massive move in Intel shares. They are rising now 26% on news that NVIDIA is investing $5 billion, and the two will team up to co-develop chips for PCs and data centers as the AI infrastructure build-out continues. NVIDIA also rising on the news, down up 3.25%. But AMD left out of the party. It is down 5.4%. But going back to the partnership, it just feels like something bigger, especially after the U.S. recently took a 10% stake in Intel to prop up the American chip maker. Meanwhile, we are seeing shares of PayPal rising on another partnership. It is partnering with Google, so shares are up 2%. They are going to partner up in online shopping, combining PayPal's checkout tools with Google's AI. And this is part of something bigger down the line that could include letting autonomous AI agents shop for you, as if I need more help shopping. Meanwhile, we have Novo Nordisk shares. They are rising 7% after new data showed that Ozempic outperformed Eli Lilly's Trulicity in a massive study involving 60,000 people. It showed that Medicare patients on Ozempic were 23% less likely to have a heart attack, stroke, or die. And for Novo, this is the edge that it wants to present in the GLP-1 race, that its treatments do a better job than Eli Lilly's at warding off heart disease. So shares are up on that news. John?
Yahara, thank you. Appreciate the update. Let's get back to that main story on our radar this morning. Intel shares surging in the pre-market. Nvidia announcing a $5 billion investment in its rival. The two will co-develop chips for PCs and data centers.
And I do wonder about what Jensen Huang's relationship will be with the CEO of Intel, especially because of his support from the president. Yes, this stake is less than a 5% stake in Nvidia, in Intel. I'm talking about the stake that Nvidia is making. And yet the idea that they're working together, I wonder how much this is Mr. President going to Jensen Huang and saying, you know, you could really get your fingerprints in this. You've done a really good job at NVIDIA. Maybe take a look at what they need to really get this underway. I'm just in the realm of speculation, but there is this sort of larger push to make it into a national champion, and I wonder how much NVIDIA is going to be a helping hand.
So many different dimensions to this. Let's build on the dimension we were talking about just moments ago, the prospect that NVIDIA has its own ask and wants to open the door to exporting the high-tech chips it would like to be selling into China. The moneymaker, Blackwell. Do you think the door opens off the back of this? Is that going to be part of the ongoing conversation with the administration? Because we've seen over the last few months, based on the experience we've had with foreign diplomacy, that Jensen Huang's ideas have been a key part of the change at the top of this administration. And perhaps he's pushing still to export those chips into China.
It goes to the question that you asked earlier. Is there a real conflict here? And there's a real tension rising for the likes of NVIDIA of how long they can count on their China business and how important that can be to the company, given the pushback that you're seeing in China on some of their local companies using NVIDIA's products. So there's this tension here that there is a push for NVIDIA to invest more on domestic production in the United States because of tension between the U.S. and the rest of the world, in particular China. And there's a push from China not to use U.S. chips in Chinese tech products. And at the same time, will there still be the ask by NVIDIA to have a larger presence in China?
Possibly, because if they can export that now, they know they'll be depended on. And they won't develop that technology themselves. Maybe that's the hope, at least that's the theory. To turn to things domestically, all the incentives are aligned here, I think, between all the partners anyway involved in this. Intel, NVIDIA, the administration. They all have a reason to build out domestic foundry capacity. And NVIDIA has a big incentive to make sure it's a success, because the last position they want to find themselves in several years down the road is being in a position where they're being coerced and pushed to use foundry capacity that doesn't have the cutting-edge technology that they require to build the chips they want to make.
And it has the extra added edge to it that it takes a really long time to get foundries up and operational. And it is a money-losing operation, which has been the challenge that Pat Gelsinger kind of complained about for a long time before he left as CEO. So it seems like this is the effort that the White House is making to try to fortify this project.
NVIDIA up in the pre-market by more than 3%. The clear winner here, though, is Intel, flying high by almost 30%. In early trading. We're going to stay on top of that story for you. I believe Dan Ives of Wedbush is going to join us in about 40 minutes' time, the big bull himself, on this show to get his thoughts on the breaking news of the last hour. Elsewhere, JP Morgan CEO Jamie Dimon making a surprise visit to Capitol Hill yesterday and meeting with Senate Republicans. Dimon saying he told the lawmakers he's not worried about Fed independence and US economic growth is so far so good. And finally, newly minted Fed Governor Stephen Miron pushing for a 50 basis point cut in yesterday's FOMC meeting. The Trump appointee acting as the lone dissenter in the board's vote to lower rates by 25 basis points.
I thought it was interesting that when you took a look at prediction markets after the fact, that his chance of being the next Fed chair rose substantially, almost doubled from 11% to 20% after that decision. And I just wonder whether his view, to your point earlier, was viewed by markets as credible. He didn't go for 125 basis points in one meeting, yes, by the end of the year, but still there was this feeling that maybe there was a credibility about him that allowed people to accept him as a governor, that maybe there were rumors that that wouldn't be the case earlier.
So in the news conference, let's park the word credible and talk about the word persuasive, because I think that's what Chairman Powell ultimately addressed just yesterday, that any one individual has to be persuasive enough to get other people on the committee to come with them. Governor Wallace talked about this directly too. As a governor, it's your job to go to the meeting and ultimately persuade others to come round to the way you're thinking about the world. And clearly Governor Waller and Governor Bowman did not join in that. And I wonder if the ultimate compromise was, I wasn't in the room and I don't know, but I'm just speculating, was that for Governor Waller and Governor Bowman, the commitment, if we can call it that loosely, to go a few more times into year end was worth it just to keep people on the same page and not dissent by pushing for 50. Just acknowledge that the committee will come with you to go another 25 at the next meeting and another 25 at the meeting after that.
I wonder if retail sales spooked them also. I mean, I do think that you're correct, but the fact that retail sales was mentioned as many times as it was, at least by Chair Powell, suggests that maybe there is this feeling that the risks truly are two-sided. But I hear what you're saying, that maybe there was a greater groundswell to keep going, which gave them comfort to just go 25.
If Governor Waller's been around, he's seen it all. He's strategic. He knows how this works. To ultimately get what you want, don't embarrass people, and you'll get there anyway.
Although some people were speculating, given the fact that Mickey Bowman and Chris Waller didn't dissent with 50, does that take them out of the running?
They're out the race now?
For becoming the next Fed chair. This was one speculation out there.
Let's stick with the Federal Reserve. Let's get to the FX market. The dollar erasing losses after Fed Chair Jay Powell described Wednesday's rate decision as, quote, a risk management cut. Kit Juckes of SocGen joins us now for more. Kit, welcome to the programme. Did you get a few more reasons to be short the dollar yesterday?
I don't think I got more. I think I got comfort. Actually, I probably got more comfort than anything watching the dollar sell off again this morning, because I came in to find that it had bounced quite a lot. Yeah, look, the Fed's going to be cutting rates. The U.S. economy is slowing at the margin. The president wants a weaker dollar, and I think we're still in a position where the world has got a lot of underhedged U.S. assets. That's going to get cheaper to hedge. And you think more people will feel a sense that I probably ought to be less long the currency, even if I want to have as much tech stock as I can or whatever else it is I need.
Okay, is that the great repatriation? And is Japan at the epicenter of that flow story?
Japan's somewhere in that flow story. I don't think it's necessarily a great repatriation as a de-risking of the currency exposure itself. In other words, I'm not convinced that anybody's ready to give up on US technology outperformance as an investment case or as US equities outperforming over the long run. I think there are people at the margin who may think the Nikkei looks cheaper than it did or that European equities do. But the big issue is just the sheer scale of the long dollar position as well, that's what feels too big.
Kit, how long can people keep buying U.S. equities from overseas and hedging the dollar? This seems to be what everyone has been doing. Is this something that is in tension? Is this something that can persist for an ongoing time with the idea of a weakening dollar and a strengthening U.S. equity market?
Well, you need the hedging cost to get cheaper so that people can hedge. So the temptation not to hedge is a function of interest rate differentials and it being expensive to hedge your equity exposure. As US rates come down relative to elsewhere, that cost is going to come down as well to hedge. So I think you'll see more people looking at it saying, look, I still like the US economy at the margin. I still want to own US equities. There isn't a real alternative, but I just don't need to be all in, unhedged, long both an expensive currency and a highly valued equity market.
The idea of a Federal Reserve that's going to prioritize growth over inflation is the reason why a lot of people are saying, like you, there is this ongoing dollar weakness. But at what point does growth outweigh some of the potential inflation if the inflation isn't that significant? The idea of growth differentials driving FX as much as anything else.
I think growth differentials are becoming more and more important, but we also have plenty of uncertainty about growth differentials. So, as we saw, earlier this year, we saw a big downgrade in people's forecasts of what the US economy was going to do this year and next. They've edged a little bit back up, and then the European ones have edged back up as well. I think the next sizable move is going to be driven by how people think of the US economy in the next 6, 9, 12 months. In other words, are we going to see that the inflation growth trade-off gets worse, or are we going to see that actually the inflation hit from tariffs isn't very big and the US economy can fly on by? I think I think we picked it up from the FOMC as well yesterday, really. There is just astonishing uncertainty about the growth outlook. But the dollar's biggest single vulnerability is a slowing economy.
Well, Kit, let's build on that. we can enter a different regime. Sometimes it's rates, sometimes it's growth differentials, sometimes it's just about investor flows for whatever reason. Kit, if it's about growth differentials, the Europeans have set the bar pretty low. They're basically telling you, based on the ECB forecast, whatever the staff forecasts are worth, they're basically telling you things are going to be in the low ones, something around 1% for Europe in 2026. Kit, based on what we've heard from the Fed, they're willing to support growth. The real story in equities on this side of the pond is that we're going to see this reacceleration in growth in 26. And I just wonder from a growth differentials perspective, whether the risk is cutting the other way.
At the moment, I think the big question mark is how much the US economy is going to slow. So if the US ended up in, let's call it the low ones, and Europe in the low ones, I think at that point, I would see a significantly weak Europe. But I agree with you on anything other than a short-term view, which is that, this is why I don't think euro-dollar can go to 130, 140, 150. It got to 160 once. We're never going to get back to those levels. This is going to be the limiting factor for this dollar sell-off. Likewise, we're not going to see the yen go back to 100 for dollar yen anytime soon. I mean decades in that sense. So I think we've got a correction here that's got further to go, and it's going to, it's going to make the foreign exchange market happy, I hope, and it's going to certainly attract attention. But let's not get too excited. I don't think that on a 10-year view, Europe can outgrow the United States.
Kit, appreciate your insight. Kit Juckes there of SocGen. Listen to the different questions that people are asking right now. Kit's asking himself, just how much is the US going to slow? And you've got equity investors coming on the programme talking about how quickly is the US economy going to accelerate in 26? Two completely different questions.
Every executive who we've spoken to in the United States over the past week has talked about a reacceleration in the United States and the pent-up demand that you're seeing in things like retail sales and mergers and acquisitions that are floating to the surface. So it speaks to, even with some sort of reacceleration, how much is actually priced in?
Looking at the dollar right now, a fair bit of weakness based on the year we've had. Dollar strength bouncing back just a touch so far this morning by about 1/10%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. With shares of Alphabet rising in the pre-market, the Financial Times reporting China is dropping its antitrust investigation into the dominance of Google's Android. The announcement comes ahead of Friday's scheduled call between President Donald Trump and China's Xi Jinping. Tesla is working on a redesign of its door handles. The move comes after a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. The redesign will make the handles more intuitive in a panic situation. An off-the-field victory for the NFL's Washington Commanders. The team won approval from the DC Council to move forward with a nearly $4 billion plan for a new stadium and mixed-use development site on the grounds of its former home at RFK Stadium. President Trump had previously threatened to block the new stadium if the team didn't change their name back to the Washington Redskins. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, the lone dissent.
19 participants, of whom 12 vote, as you know, on a rotating basis. The only way for any voter to really move things around is to be incredibly persuasive.
In just a moment, we'll catch up with the former Kansas City Fed President Esther George from New York City this morning. Good morning. You're watching Bloomberg TV. Two days of very mild losses in the equity market and bouncing back pretty strongly this Thursday morning, up by 0.75% on the S&P, up by 1 full percentage point on the Nasdaq, and the outperformance on the Russell returned, small caps higher by 1.3%. The movers to watch this morning, Intel, Nvidia, Intel up by close to 30%. If you're just joining us, you missed quite the announcement 50 minutes ago. Nvidia agreeing to invest $5 billion in Intel, saying the two will co-develop chips for PCs and data centers.
Yeah, that's almost a 5% stake that NVIDIA is taking in Intel at a time when the government has clearly thrown its weight behind Intel to try to make it into a viable competitor with foundries across the world. A real question about how far this partnership will go and who's next.
Dan Ives is going to join us next. Says this is bullish for NVIDIA and Intel. brings intel to the table on AI and could change the thesis. Goes on to say, this could change the way the stock is valued. It's a huge game changer.
I wonder how much this is a vote behind the idea of Jensen Huang also having a seat at the table when it comes to Intel management, because it's been a real question. Pat Gelsinger left, new CEO came in, a question of how do you do this in a way where it takes a long time to get a foundry up and running, and then convincing people to use them when TSMC is very good at what they do.
That stock is the big winner so far this morning. Let's turn back to the Federal Reserve. Under surveillance this morning, the lone dissent.
19 participants, of whom 12 vote, as you know, on a rotating basis. The only way for any voter to really move things around is to be incredibly persuasive, and the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's in the DNA of the institution. That's not going to change.
So here's the latest this morning. The Fed Chair Jay Powell attempting to unite a divided committee at this week's policy meeting, with the newest governor, Stephen Myron, the only vote against the 0.25% interest rate cut. Joining us now to discuss, the former Kansas City Fed President, Esther George. Esther, welcome back to the program. I love talking to you about this because you've experienced it. You've been there.
Morning.
You've dissented on the committee yourself personally, and you've seen dot plots with huge dispersion and a wide range of outcomes for the years ahead. Is this different somehow from what you've seen and lived? Is this somehow different, what we saw yesterday?
Well, it's different in this sense, Jonathan. You have a lot swirling around today's economic decisions that have to be made about monetary policy. They come from challenges to the institution itself. They're coming from an economy that is far from clear in terms of what the ultimate impact is. And again, this is a committee that has to think about the long run, even as they make today's decisions. And so you have dramatic changes in trade policy and immigration policy, all that are hitting directly on both uncertainty about where that long run is, as well as where are things landing today. So not surprising, I think, that you see this kind of dispersion, given the changes going on in the economy.
Given that type of a backdrop, do you think, Esther, that we're looking at a scenario where forward guidance has no value anymore?
Well, I don't think this is a time you can make forward guidance. And really, forward guidance can be fraught anytime because we live in a dynamic economy. Things can change that make it hard for the central bank to fulfill commitments like that. And so, again, this is a time where you hear from businesses. They are still sorting out what the end game looks like here. They are still sorting out what increased costs are going to mean to both their bottom line, to their employment status. And so it's hard to put a pin that you can see a clear direction for the economy. I think you heard that coming out of the meeting yesterday. The committee had to make a decision. They made a decision, but the dispersion, I think, belies some of the consensus you saw.
Esther, can you talk a little bit about how hard it is to persuade fellow governors to get on your side? When you do dissent, when you do disagree with them, how difficult it is to make that case?
Yeah, so it's a requirement of the job. I always thought in that. And certainly you are trying to articulate in a very thoughtful way the factors that weigh on your judgment, how you put the weight on different variables, which everyone around that table is doing. At the end of the day, though, that you are the lone dissenter, that the majority makes a decision in a different place, doesn't necessarily undermine the argument that's being made. It simply says that the weight was in another direction and there was consensus built around a different view. I think what's important is that you don't dismiss entirely when you hear dissenting voices about what it means.
Esther, as you look through the forecast, a lot of people have called them highly contradictory. There are some odd things going on just in terms of upgrading the outlook for growth and then cutting interest rates. Some things don't make sense to some people. You know, when these things were introduced, the dot plot and forecast, it was to enhance communication. Do you think we've got to the point where it started to compromise it?
Well, that's been the case at many times since the introduction of that dot plot. And again, I think it always bears reminding people, this is not a committee forecast. yes, you can draw some conclusions about tendencies and the medians where they come out for this committee. But when you see dispersion like this, it tells you that we're looking pretty short term. This idea of meeting to meeting sounds right to me. You don't have a committee that agrees on what the long run is. And that's true either of their long run Fed funds forecast. Those are ranging from below 2.5% to closer to 4%. That tells you that this idea about how restrictive they are has a lot of different views coming to bear at the table.
Esther, I think a lot of people would agree with you, most in fact, that you shouldn't draw too many conclusions from those forecasts. But there is one uncomfortable conclusion that many people have drawn, and that this institution is no longer credibly pursuing the 2% inflation target. Is that an unfair criticism?
Well, the committee certainly has not said that. We have not heard the chairman say that. But I think the actions here put them at risk over the next few months, frankly, because they continue to push away from thinking that inflation, although characterized as an upside risk, is one that they are not going to be able to deal with. And I think the challenge there is this is a committee that has relied heavily on anchored inflation expectations. And as those move, and as the public, which has experienced high inflation, I think this will become a real challenge for the committee under the forecast that they've laid out.
Esther, you're always generous with your time, and we appreciate leaning on some of your experience as well. Esther George there, the former Kansas City Fed president. That was one of our big questions yesterday afternoon.
Yeah, exactly what the response would be to inflation that went up. Was it a short-term one-off, or is it something that the Fed is going to take under consideration? What Esther George said there was really interesting. Inflation expectations in the public. Which inflation expectations? Are we talking about the University of Michigan inflation expectations? Are we talking about the break-even rates in markets? How does the Fed measure this, given the difficulty getting your arms around such a concept?
Mohamed Al-Arian said this a few years ago. Took some heat for it too. He said if you were to design a new inflation target for the Federal Reserve, it wouldn't be 2, it'd be closer to 3. The world's changed. The world's changed.
And right now, it seems like tacitly, this Fed is acknowledging that, saying 2 years. 2 years.
Yep.
Wait more, 2 more years.
2-year rolling view over at the Federal Reserve. Up next on the programme, Alex Altmann of Barclays, Dan Ives of Wedbush, Nela Richardson of ADP, and Adam Hetts of Janus Henderson from New York City. You're watching Bloomberg TV.
This is an insurance rate cut. It doesn't really foreshadow what's going to happen going forward.
This is all about risk management.
This is a Fed that locked arms. One dissent was surprising.
It's really clear that Powell corralled the cats.
We're all kind of hot and bothered by this move, but the truth of the matter is we're not in neutral territory yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. What a rally, up by 0.8% on the S&P 500, up by more than 1% on the Nasdaq and the small caps. But it's the rally here that we need to talk about. 2 single names in the pre-market, one absolutely dominant. Intel, up by almost 30% in early trading. Nvidia up by 3%, the headline that dropped about an hour ago, 60 minutes ago. Nvidia agreeing to invest $5 billion in Intel, co-developing chips for PCs and data centers.
This is getting a lot of people's attention, not just for what it means for Intel, which was beaten down and trying to be the singular national champion when it comes to foundries and chip production in the U.S., but going forward, how much weight the United States is going to put behind certain national champions. We already saw the U.S. government get a 10% stake in Intel, although we don't really know exactly what that looks like in its entirety. We still are getting more details on that. This just adds to that with the extra eyeballs of Jensen Huang in the Intel C-suite.
Who's going to follow? You asked the question. Who's next? Who else wants to invest in Intel? A lot of people could benefit from developing domestic foundry capacity. The other question we've asked too, what does Nvidia get in return? What's the big ask they've got of this administration? Could that open the door to the high-tech chips being exported to China?
Which is the ultimate tension, given the fact that the foundry development is in direct response to trying to become self-dependent when it comes to chip production and not dependent on Asia, not dependent on Taiwan, given its fraught relationship with China. This decoupling, how far can it go, and how far does it really push NVIDIA and other tech giants to choose, given some of the questions around the boundaries of their investments over
So
China?
many different stories here.
I mean, it's
Intel also has a big presence in China. What does China think about what's happening with Intel right now?
Yeah, and $5 billion for NVIDIA is essentially spending cash that you would find in your couch. So let's just be honest that this is a definite significant move in terms of what it signals for its arch rival. But $5 billion for Jensen Huang is basically what he gives to his kids for allowance.
Yeah, it's a few coffees and breakfast.
Exactly. It's ridiculous.
It's a different world, isn't it? Equities right now in the S&P 500 up by 0.75% on the S&P. In the bond market, yields are lower across the curve, 2s out to 30s. As we build and reflect on what happened yesterday at the Federal Reserve, a very divided committee and a chairman attempting to unite everybody.
Yeah, and failing to do so. I think that a lot of people would agree that this was a messy conclusion given the lack of clarity in the underlying economy, the lack of clarity as to what the committee is going to look like come next year, and the lack of any kind of conviction around both the dual mandate of employment and inflation. It does seem like the one takeaway is this committee is willing to live with inflation above 2% for yet another year, as long as you don't see any kind of dramatic weakening in the labor market, and that is the ultimate priority.
And stock markets kind of like it, apparently. 87 minutes away from the opening bell, we could reclaim all-time highs. Coming up this hour, we'll catch up with Alex Altmann of Barclays as stocks trade near those record highs. Dan Ives of Wedbush as NVIDIA has taken a $5 billion stake in Intel, and Nela Richardson of ADP as we break down the latest jobs data. Haven't mentioned it once. Jobless claims about 26 minutes away. We begin this hour with stocks edging higher as the Federal Reserve delivered its first interest rate cut of 2025. Alex Altmann of Barclays joins us now for more. Alex, good morning. It's good to see you.
Good morning.
Odd situation. The Federal Reserve did not meet this market. It fell well short, and here we are Thursday morning with stocks running again. Make sense of that.
I think we've already just discussed it, is that the Fed basically has a split committee right now, and trying to thread that needle is an incredibly challenging thing to do. They clearly are under pressure from the administration, and obviously Miran now sitting on the FOMC is going to add more of that pressure. I think that on top of that, you've also just simply got a very K-shaped recovery. And I think people overlook this, right? We've had one part of the economy that is basically the stock market, AI, technology that's dominated, is not interest rate sensitive at all. And another part, manufacturing, housing, small companies, and obviously several quintiles of the consumer. They've really been struggling, and they've been struggling for 2 years now. And you can see that in the performance of small caps. You can see the performance of the ISM. And I think that the Fed is now under pressure with the cue of the labor market to actually start doing something about that.
I'm pleased you brought this up because the payrolls data is driving the Federal Reserve, at least many members of the committee. It's not driving the equity market. What's driving the equity market is the capex intentions of a handful of companies and the kind of headlines that we were just talking about regarding Intel and NVIDIA. Are there limits to that story? How far can you push the bad data for the Federal Reserve and the good numbers for the equity market?
So I think that's one part. The AI component, without a doubt, Jonathan, is important. So we're talking about that contributing 1% of GDP this year, maybe 60 to 70 basis points, depending on where you sort of throw out consensus for AI capex next year. But then we've also got the OBBB, right? The one big beautiful bill. That's going to add 30, 40, maybe even 50 basis points of GDP next year in a more targeted way as well. And now you've got a nascent manufacturing recovery as well, as a function of that OBBB, as a function of that ancillary from the AI capex. So you're absolutely right. It definitely has been a big driver of the AI capex, but it's not exclusive. We've actually seen a broadening of the S&P rally over the course of 2025, more so than 2024. And that, was part of the reason why we were very constructive on small caps. And that, I think, actually continues as a function of these rate cuts. And people really forget that these rate cuts are having a massive impact on a regime shift within the equity market, where we're so used to just this AI story dominating it. And actually, you start lowering interest rates, you've got a huge cohort of not just the Russell, but also the S&P that's got variable rate debt, and is going to start getting a real kicker from that pretty quickly.
So this goes to the question of yesterday's price action, and we saw rotation into the broader equal cap S&P 500, the Russell 2000. Do you think that has legs, or do you think that ultimately a rising tide lifts all boats? There is some catch-up, but that this is going to be still a very much tech-led rally?
So look, I think we need to, it's a really good question. We've got to clarify this because the US equity capitalization is $67 trillion, give or take. The Russell is $3 trillion. So this concept of rotation is, I think, a bit of a misnomer, right? I think that if you want to, people say, oh, we need to rotate out of AI and into small caps. I'm like, well, if you do that, you probably will tank the stock market. So it's when we talk about the broadening, we mean exactly that. It's not about being necessarily bearish on AI, although that's a bigger discussion about what does that forward of CapEx look like? How much emphasis do we need to place on that to rely on GDP growth next year? And we can discuss that. But it's more of a case of there's this corner of the market that is the market cap is smaller than Google or Nvidia, and it has been overlooked, and understandably so. But now I think it's time to shine, and that's what we've seen spectacularly, not just in things like IWM over the past couple of months, but residual volatility factor and certain factor behaviors within the equity market have seen some of the most incredible rallies, some of which we've really never seen since COVID.
So I'm struck by the fact that the committee of the Fed is split when it comes to just how much there is this concern around the labor market and some sort of slowdown. When we talk to the United CEO, when we talk to Bank of America and Brian Moynihan, they are talking about seeing a reacceleration in the economy. They're talking about companies that are borrowing more, pulling triggers on deals. How much is this increasing the international appetite for the United States and for equities here, given the fact that the Fed might be on the fence, but they're cutting rates, which is only fueling this expectation for a reacceleration?
I think that a lot of it boils down to the administration that wants to run the economy hot. I think a lot of it is driven by that, and I think we have to acknowledge that there has been that external influence on things, especially going into the midterms. And by the way, I just want to give you a stat on this. Anytime the Fed have cut interest rates within 1% of all-time highs for the S&P has been up 100% of the time 1 year later. In fact, it's been up 88% of the time 2 months later. So there is definitely a self-reinforcing mechanism here. And the whole notion, remember the old adage of stock market's not the economy? Well, given that the wealth effect of the US households is so exposed to stocks now, there is this circularity where stocks being at all-time high can fuel consumer sentiment, can propel the economy in a very much sort of circular fashion. So it's no surprise that, that all of a sudden consumer spending is picking up again as the S&P's at all-time highs and they're cutting interest rates. The question is, what is the price we're going to pay for that down the line?
Can I just ask you something about the future? You run tactical strategies. When does someone like you start to consider the future of the Federal Reserve and the post-Powell world and the fact that that dot at the very bottom of the dot plot, which most people correctly assume is Governor Myron's, that ultimately that could be the Fed chairs in June next year?
I think we're thinking about it now. And I think that's contributed a lot of what we've seen within this internal rotation that's been going on since June. And that will most likely continue because there is still going to be a line of sight on the fact that the current Fed chair will not be in his seat from May next year.
You said for what the price is that we pay down the road. Are you saying this is creating a bubble?
I think there's a real chance that we do create a bubble, and I think that everyone who invests in equities has to acknowledge that. Ironically, we're actually trading at a lower valuation today vis-a-vis where real rates are versus this time last year. So I think that there's actually a case to be made right now that there was more exuberance in the market, say in parts of 2021 and even parts of 2024 in the wake of the election than there is now. That's not to say that we can't fuel and create a bubble. And I think what people often make the mistake of is assuming if there is a bubble, and I'm not saying that categorically there is one, but they can go on, that's it, that it's done. But it typically goes on for a lot longer than people tend to think.
Julian Emanuel was talking about that career risk.
Yeah.
Do you feel some of that? You can be honest with us. You work on Wall Street. Do people you speak to feel that? Do a lot of people feel that career risk of not being long enough in a market like this one? Is that more important to them than worrying about downside risk?
I think for the most part, just from personal experience, having run money and also sitting on the sell side, I would say that generally in up markets, people are more relaxed. So yes, of course, if you're running a benchmark fund, long only, I think there's always going to be pressure to obviously perform that benchmark. And you would have seen the charts and the percentage of long onlys that underperform in any given year. From an absolute return strategy perspective, as long as you're making money for your LPs, generally you're in good shape. That is your job at the end of the day, and to manage drawdown risks. But within a bubble, of course, yes, if you start seeing explosive continued 20, 30% rallies in the market, and you're dramatically underperforming or not making money at all, then inevitably you're going to feel some pressure.
You don't get paid for being bearish in a market like that one. I've heard so many stories about the late 90s. We heard a few already this morning.
Yeah, this is the reason why bubbles can continue for a very long time, even if everybody thinks they feel a little frothy. Although what Alex just said there was really interesting, that based on where rates are currently, valuations are actually lower today than where they were last year. So I think it's important to remember, maybe we're, in the first inning of a 9-inning bubble. I hate using baseball analogies, but here we are.
You did.
There you go.
Anyway, Alex, thank you.
Thank you.
It's good to see you.
And you.
Alex Altmann there of Barclays. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Shares of Intel surging in the pre-market following an announcement Nvidia is investing $5 billion in its rival. The company said they will co-develop chips for PCs and data centers. Nvidia will buy Intel common stock at $23.28 per share. That's a 6.5% discount to Wednesday's closing price. Sources telling us here at Bloomberg that the European Union is planning to present a new package of proposed sanctions against Russia as soon as tomorrow. The proposed penalties follow a phone call between the EU's Ursula von der Leyen and US President Donald Trump. Von der Leyen said the sanctions would target crypto, banks and energy. And shares of Novo Nordisk are gaining in pre-market trading after beating Eli Lilly in a real-world study. The study followed nearly 60,000 people with diabetes and heart disease and found Medicare patients who took Novo's Ozempic were 23% less likely to have a heart attack, stroke or die than people on Lilly's Trulicity. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next, the morning calls, plus Dan Ives of Wedbush, as Nvidia is taking a major stake in Intel. The big news of the last hour or so, that's next. This is Bloomberg. The President has respected the UK tradition of the last 24 hours, meeting the King, and reflected on an old partnership between the UK and the US. He's now alongside the British Prime Minister, Keir Starmer, talking about a new partnership potentially between Intel and Nvidia. In Buckinghamshire, the United Kingdom, the President and the Prime Minister hosting business leaders in the UK today. And in that room is the Intel CEO, Jensen Huang, after Nvidia agreed to invest $5 billion in Intel.
Yeah, you've got Jensen Huang of NVIDIA there. You have, of course, Tim Cook as well. You also have Mark Zuckerberg, and you have the OpenAI chair and founder, Sam Altman. And a real question here about what the commitment will be, how the UK will carry this out, and how much these tech leaders are a chip in international negotiations for the United States in an increasing way.
We've got Mandeep Singh of Bloomberg Intelligence alongside us. Mandeep, good morning.
Morning.
It's good to see you. I have no doubt the President's happy with this move. Not on Nvidia, but on Intel, higher by almost 30% in the pre-market. Your first reaction to that deal?
Well, I mean, look, from an Nvidia perspective, I don't see a big strategic rationale, given Intel has been such a big competitor over the years, except for the fact that Nvidia has a very healthy balance sheet and it's been making investments, in CoreWeave and some other cloud providers. So $5 billion is not a big amount for them, given their balance sheet. And co-developing chips, to my mind, Intel's kind of ecosystem revolves around x86 and they dominate in the PC world. So that's where NVIDIA can use their distribution. But the fact that they are not using them in Foundry, I mean, that just goes to show that they don't want to touch that TSMC ecosystem where they dominate. And so it's more of, you have to convince the government that you're doing something about it. I mean, clearly, government has a 10% stake in Intel now. And, this was probably the best way to go about it.
What do you think NVIDIA might get in return? Have you given that some thought?
Well, the PC refresh cycle, we have been waiting for that for a while.
I'm thinking more of what the President might be able to give them. Access to China, selling their high-end chips.
That's definitely on the cards. And look, getting to a monopoly position is never a good thing for a company. That's what we have learned from Google, because, once you get to a monopoly position, it attracts so much attention. So to my mind, NVIDIA wants to keep competitors who are distant, third or second. And so from that perspective, it's good that Intel will be a competitor. but at the same time, NVIDIA still maintains the lead and they don't get classified as a monopoly.
Dan Ives of Wedbush is standing by, wants to jump on. He calls the deal a huge game changer for Intel. Dan, good morning and welcome to the program. Why do you believe this is such a huge game changer?
Pop the champagne. I mean, for Intel, now you have NVIDIA, godfather of AI, doubling down. And this follows, obviously, U.S. government investment. I mean, what this essentially does, it brings Intel into the AI game. You think from a stock perspective, that changes the multiple. And, clearly, this is also going to be viewed very positively in D.C. I think that's something that could definitely help Jensen and others when it comes to China.
Dan, I do wonder, though, about Mandeep's point, this idea that this isn't NVIDIA going all in and developing their chips for the big semiconductors, the big hyperscalers at the Intel foundry. This is simply a $5 billion side project about PCs. How much is this essentially just an olive branch to the president and not an actual move of NVIDIA to try to fortify Intel's plans to become the foundry?
Yeah, look, Mandeep brings up great points as always. But look, this is also, it's a doubling down on investment in the U.S. I mean, that's also what it is. Now, clearly, that obviously olive branch to Trump administration and others. But what they're also doing is when it comes to PC upgrade cycle, x86, I mean, this does give them another potential growth lever. And look, NVIDIA right now, it's NVIDIA's world, everyone else is paying rent. And they know that they're in a massive position of strength. But for Intel, I mean, think about it, you went from, call it a month ago, some worries about, in terms of the CEO potentially out. Now you get the investment from government and you have Intel, now again, NVIDIA. I mean, that is a Goldilocks scenario for Intel.
This is coming at a time when China is trying to emphasize domestic production of their own technology and really trying to create national champions there that can rival NVIDIA and other U.S. tech giants. I just wonder whether it is possible to continue for the likes of NVIDIA trying to push into China, trying to sell more advanced chips into that country while at the same time playing with this idea of U.S. independence from China.
Look, it's a tightwire act, but the reality is that there's one chip in the world fueling the AI revolution, and that's led by godfather of AI, Jensen, NVIDIA. And that's why in China, look, they could tell Chinese big tech in Beijing, don't buy NVIDIA chip. That's like telling a kid, okay, don't eat the candy that's on the table. So that's the reality because they're years ahead of when you look at Huawei and others. But at the same time, I mean, Trump administration recognizes they have to strengthen AI infrastructure, AI chip making. And you look at Intel, I mean, they've gone obviously from a huge laggard. I mean, Intel, all the red tape, all the sort of black eye moments, you finally have some positives at Intel.
If you are just joining us, welcome to the program. The President of the United States, Donald Trump, alongside the British Prime Minister, Sir Keir Starmer, hosting a business meeting. The President just opening up his remarks. Let's take a listen.
We have to deal with you, and you are the best. You're the best in the world, and you're here. And it's an honor to have all of these great leaders. Really an honor. But I'm sincerely grateful to Prime Minister Starmer and Lady Starmer for welcoming us to this very special home, this beautiful place. And I was here a number of years ago, but somehow today it looks even better, even more beautiful, and even more historic. Melania and I are forever thankful to His Majesty King Charles III and Her Majesty Queen Camilla. We had a fantastic evening last night. But the exquisite honor of a second official state visit, the first ever, it's the first time it's ever been done, was, really was an honor. Such great history, and to think it's a first. It's always nice to have a first. But the ties between our countries are priceless, and it's really an inheritance. It's a beautiful inheritance. Today we're making those ties closer than ever before. We've done some things that financially are great for both countries, and we work together, and it keeps us together, and I think it's an unbreakable bond we have, regardless of what we're doing today. I think it's unbreakable. But this is very big, and I want to thank all of the incredibly talented business leaders, the best in the world, biggest in the world, here this afternoon for investing in the Anglo-American Alliance. And You personify an important part of the unique national bond and really a world bond. What you've done is incredible. Our two countries do a great deal of business together. $340 billion last year was the number. In May, the United Kingdom became the first country to make a trade deal with the United States during my second term, and we sort of wanted to make it the first because the bond is so strong and the relationship so long. That agreement will create billions of dollars in opportunities for American farmers to sell their products into the UK, reduce barriers to trade, and give the U.S. manufacturers better access to the UK's world-class aerospace supply chain, which is really is world-class. A lot of people don't understand it, the importance of that particular asset that you have. It's a beautiful job you've done. There's no more natural partnership in the world. Together, we're building up the industrial capacity of both of our countries, which is crucial to our defense. And we work so well together in defense. I met so many of the leaders of your defending group, and many of them I've known by name, but now I know them pretty well. We had some very good meetings today and yesterday. So we're taking the next logical step with a historic agreement on science and technology partnerships, and this will create new government, academic, and private sector cooperation in areas such as AI, which is taking over the world. I'm looking at you guys. You're taking over the world, Jensen. I don't know what you're doing here. I hope you're right. All I can say is we both hope you're right. But it's pretty amazing. Quantum computing, fusion, 6G, and civil nuclear energy, and align our nations through the approach of centered deregulation and innovation. And we're going to have a lot of deregulation and a tremendous amount of innovation. It's just happening. But this new accord is already helping spur a massive wave of private sector deals worth over $350 billion alone, headlined by a $136 billion from Blackstone. That's very nice. Steve, thank you. That's why you have that location, I think. It's considered the best seat of the year. Yours is pretty good too, Jensen. That's good. That's great, Steve. You know what you're doing better than anybody. American company X Energy and British company Centrica has been announcing, and really for a long while they've been talking about this deal, the deployment of modular nuclear reactors across the UK, all across the UK. It's been in the wind for a couple of years, and now we're getting it done, generating more than $50 billion in economic value, creating up to 2,500 jobs, and powering 1.5 million homes. That's a lot of homes. 7 decades after British genius Alan Turing pioneered the field, this agreement will also help America and our British allies dominate the future of artificial intelligence. You need the energy. You have to have the energy. That's one thing I learned very quickly. They need a lot of electricity. In the United States, you need double what we have right now just to maintain that fight. We're right now, and I want to say, leading China and the world by a lot in AI, a lot. And we're creating tremendous amounts of energy and letting you create your own electricity in many, many cases. And we're giving you very rapid approvals. We're getting them approvals like they've never seen before. They used to wait 15 and 20 years to be rejected. Now they wait 2 weeks or 3 weeks to be accepted. That's a pretty big difference. And at the same time, we always have the environment in mind, but we move them along. But we're committed to ensuring that you have secure and reliable sources of American AI and quantum technology. We intend to always be the UK's strongest, closest, and most trusted business partner. Very important to us. The relationship is very important. 1 year ago, our country was in serious trouble. The King of Saudi Arabia, a great gentleman, you all know him. He said, "Sir, your country was dead 1 year ago, and now you have the hottest country anywhere in the world," and it's true. We'll have more than $17 trillion invested in our country this year, 17 trillion, which is many, many times what we had last year, and we're only in our just about almost 9th month, it's moving along quickly. It's amazing. I was saying we're in our 3rd month, our 4th month, our 5th month, but it's It's going to be over $17 trillion. No country has ever had anything like that, even close. GDP last quarter was 3.3%. Despite all of the things we're doing, one of the things we're doing, which I'm very proud of, is the border. We now have a totally closed border, totally secure for 3 months. 0 people came into our country, bad people. And they come in, but they have to come in legally. We have a great process going. And inflation is virtually non-existent. As you know, we're taking in trillions of dollars from tariffs, and they've been so incredible for our country, so incredible. We're keeping our companies happy. We're keeping them solid and sane, and they're very, very thrilled at what's happened. They can't even believe it. And we've never seen investment like this. Without the tariffs, we would have just a fraction of that. And we're really the only one that can do tariffs. Nobody else is able
Perfect
to do
timing
it.
from the president there as he started to reflect on the state of the U.S. economy. That's something we have to do in just a couple of seconds' time. We're about 20 seconds away from jobless claims, so I want to bring it from the UK back here to the United States to focus on that data as it crosses. Going into it, equity futures set up as follows. We're positive by about 0.8% on the S&P. On the Nasdaq 100, higher by 1.2. On the Russell, small caps outperforming by 1.3. In the bond market, yields are a little bit lower across the curve. Yields down by 2 basis points at the front end with the latest economic data. Let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we do get a snapback in jobless claims. After the big rise last week, we fall back to 231,000. That's below the estimate. Last week was revised up by 1,000, so it was 264. But remember, this was all in theory because of fraud in Texas. Texas officials say there were a whole lot of illegal filings the week before, and that looks like it is the case. The ongoing claims number is 1,920,000. That falls from 1,927,000. So the jobless claims numbers improve, take a little bit of that edge off in terms of what's happening with the economy. Of course, the Fed sticking with that. Now, Philadelphia Fed is out as well. It jumps to 23.2 from negative 0.3 in terms of the overall number, and the prices paid index drops to 46.8 versus 66.8. So a significant improvement on the inflation side for Philadelphia Fed. Don't have the explanation for that yet, but we'll look into it.
That's the pickup in activity that so many equity market bulls are looking for. Mike, stay close. I want to come back to you on the Federal Reserve in just a moment. I want to break down these numbers with Lisa. So jobless claims come in with a nice downside surprise, 231. As Mike pointed out, in the previous week, had this odd quirk coming out of Texas. A lot of people thought that maybe they were the wrong kind of filings for unemployment benefits. Claims have come back down to 231, fraudulent filings with the conversation that we were having last week. So the good news is that we've returned back to the 230s on jobless claims. That's taken some heat out of the bond market rally. Yields come back up just a little bit across the curve. Yields were down 2 basis points at the front end, now just about unchanged. With that kind of move, push it through foreign exchange, starting to see the comeback of the US dollar. Just a little bit of dollar strength against the euro. Euro dollar shaping up as follows on my screen on the Bloomberg, 118.06, so slightly negative now on the session. So that's some good news, Bramo. That's the right kind of downside surprise on jobless claims.
And it coheres with what we're hearing from a lot of people, which is, and I'm talking about business leaders who say that the labor market isn't falling off a cliff. And if anything, there is this feeling of reacceleration in the underlying economy. And certainly we've seen that in spending. I just wonder, based on the muted reaction in bond markets, how the 2-year isn't ripping higher. It is a little bit higher. How much this really signifies that the Fed has put a cap on how high those short-term yields could go, regardless of how good that economic data could be.
Mike, I want to build on the data and get your thoughts on the Federal Reserve. You spent time in the news conference, listened to Chairman Powell intently, had your own remarks to make and your own interaction with him. What is anchoring their view of the labour market right now? Is it payrolls? Is it the unemployment rate? Is it claims? What is it?
It is payrolls at this point. They're looking at the drop in the number of people getting hired and starting to worry. That means that companies are going to start cutting back on people if their margins are compressed because of tariffs. But we haven't seen a sign of that yet. We're still seeing business leaders say we're sitting on our hands. We're waiting to see what's going to happen. But the Fed sees more danger in that than they do in inflation, which they're describing as a one-off. But of course, Gary Cohn yesterday from IBM saying that this could stretch out. Companies could stretch out the process of raising prices. So it is sort of without a lot of conviction that the Fed is making the choice to focus on employment at this part, and that could change at any time when we get new inflation numbers.
Mike McKee with the latest. Michael, great work yesterday. Thank you, sir. Appreciate it. Nela Richardson of ADP joined us in the studio. Nela, good morning. It's good to see you.
Good morning.
This is a tough one to read. You help us out. Where is this labour market right now? What's happening?
Labor market is strong, actually. It's solid. And I think there is a comment that has to be made. It is weakening, but the labor market is not weak. And if you look at the stock, and that's what a lot of your audience is used to doing, looking at the stock and the flows. If you look at the stock, what you'll see is that the consumer is really smoothing out all the rough edges in the economy. And it's true for the labor market as well. There's very little turnover in this labor market. I was really shocked by that upward surprise in jobless claims last week, and now I know that that was just a mirage, and we're back to historical lows. There's very little flow out, and there's very little flow in, but what that means for the consumer is that they're not defying gravity when you see that pop in retail sales. They are well anchored by a functioning labor market where they are employed and working, and those incomes are fueling spending. And as long as that continues to happen, we can live with the uncertainty of fewer flows and hirings in and out of the labor market if the stock is healthy.
Well, and this raises the point that maybe this is the new normal, this sort of low hire, low fire type of churn. And I just wonder if that's true, if that's the case, or if you do see some sort of reacceleration in hiring, especially if there is some sort of commensurate reacceleration in the economy heading into the end of the year.
Yeah, so that goes back to the weakening. And I do think the labor market is weakening, but not for the reasons that were explained yesterday. Not simply because of the hiring rate, but really the concentration of hiring. And Lisa, you and I have talked about this a lot. If you look at the BLS data, if you look at the ADP data, what you'll see is a heavily concentrated hiring market in key consumer sectors, whether it's healthcare for the BLS or leisure and hospitality and ADP. It's the consumer who's driving hiring, and the consumer's wins are really forming and shaping today's labor market. I think that's a concern. You want broad-based hiring. You don't want it concentrated. That's not good for the future. So there are reasons to be concerned about this labor market, but the ones in terms of just the number of jobs that are added every single month, I think that's not the biggest problem with the labor market right now.
Going forward, we've been talking about the conflict between the real economy and this idea that there is something kind of quirky or not totally healthy about the labor market, and the idea that you're seeing this boom in a select number of stocks, but it does seem to be broadening. Do you think that that also is the new normal? That companies can keep doing really well but not increase their headcount considerably or invest in talent? Or do you think that this is something that has to reconcile?
In stock markets and companies, the truth is if you're not growing, you're not going to be around for long. And I think that when we look at the labor market, what I see is a tipping point. I see a labor market that is very dependent on the consumer and a consumer that is very dependent on the labor market. And I think this is an uneasy truce. It's a delicate relationship because anything could upend it. And that is the issue for companies as well. If their demand is coming from a resilient consumer only, and that consumer is dependent, and most of us are, on the labor market, then you can see how these fractures could lead to something bigger for companies right now. So they're very dependent on that demand outlook, and it's uncertain. And there's a lot of risk around it.
So yesterday felt really messy.
Mm-hmm.
Listening to what you've got to say about things, could these decisions get messier, given how difficult it is to read things at the moment?
You know, Vice Chair Jeffries gave a speech about 2 years ago on the difference between uncertainty and risk. And that term risk management really stood out to me because risk is something where you don't know the outcome, but you know the distribution. And therefore you can act to, in a way, if you're the Fed, to, try to tilt towards an outcome that is preferred. Uncertainty, you don't know the outcome and you don't know the distribution. And I think we're there more now than we were even 2 years ago. We have an uncertain distribution. So it calls into question whether a short-term rate move is really going to affect these long-term structural issues tied to demographics, immigration, and higher inflation than we're used to.
With that in mind, as they get closer and closer to neutral, how do they confront the situation you've just described?
Historically, they've done so with data. and really having a strong read of not only where the economy is now, but where it's going. And that is going to be critical because they have to work in two time dimensions, right? Now and the future. And right now, things look pretty good. The stock, like I said, for the labor market is pretty good. The unemployment rate is below what we've seen historically. But in the future, if these structural changes become live, real-time constraints to the economy, then the Fed has to act and act quickly. And that is the uncertainty that we're all going to be grappling with.
Just a random question from me. How long before college graduates actually get jobs?
Well, my son graduates in 2 years, so I'm hoping for that.
I'm serious, though. When's that going to come back?
I think for early career, we're also seeing a complex relationship, right? Because we're seeing they're entering a jobs market where AI is becoming more and more present in their skill set. And when you think about where AI shows up for these for careers in general, it's showing up, according to research done by Stanford using ADP data, in early career in AI-exposed fields. And that's not just software developers, that's marketing, that's finance, that's anything that you use a spreadsheet or some kind of document to do. So I do think that there is a transition point. The good news is, in this very stable labor market, companies are leaning into employee engagement, employee training, employee upskilling in a way that they weren't doing before the pandemic. So there's hope that if the economy stays strong, that this early career population, which is our future, will be trained into those durable jobs.
I share that hope, Nela. I hope you're right. Nela Richardson.
We got
ADP.
2 years.
Thank you. Not just for you.
I've got a little longer, but not much.
For everybody. Bramo, it's a huge issue. And if everyone's right, the equity bulls in this market that come on this programme talking about the re-acceleration into next year, I hope that brings the labour market with it. And that's not the kind of jobless acceleration that you've been talking about.
Yeah, and how much companies, to Nela's point, invest in training. And we were talking to Brian Moynihan yesterday, and the sort of subtext to some of the conversation is that the big banks are training and some of the others are stealing because they don't want to train. And this does take money and it is inefficient. So how do companies have the conviction to do that if they kind of like ChatGPT and think, they can get their own coffee?
Some good news, at least this morning. In the last 10 minutes or so, jobless claims down to about 231. 231 against an estimate of 240. The previous number, a revised 264. You want some coffee, don't you?
I have.
Yeah, okay.
I have like about a third of a cup. I'll get my own later.
Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Recapping that data then that we brought you just a few minutes ago. Initial jobless claims dropping by the most in nearly 4 years last week. Claims fell by 33,000 to 231,000. The median forecast in Bloomberg survey of economists called for 240,000 applications. China's Huawei unveiled a plan to challenge Nvidia's dominance in the AI chip market. The company unveiled its new SuperPod cluster designs that can link more than 15,000 of its Ascend AI chips together to boost computing power. Huawei plans to roll out the new models in 2027 and 2028. Shares of Alphabet rising in the pre-market. The Financial Times reporting China is dropping its antitrust investigation into the dominance of Google's Android. The announcement comes ahead of Friday's scheduled call between President Donald Trump and China's Xi Jinping. And that's your Bloomberg brief. John.
Vonnie, thank you. Appreciate it. Thanks for this morning. Up next on the programme, Hetts of Janus Henderson as stocks trade near all-time highs. Plus, Yahaira with your morning movers as Intel shares surge following a deal announcement with Nvidia. That stock is up by 30%.
Committee that has to think about the long run, even as they make today's decisions. Not surprising, I think, that you see this kind of dispersion, given the changes going on in the economy. When you see dispersion like this, it tells you that we're looking pretty short term. This idea of meeting to meeting sounds right to me.
There was a lot of dispersion in the forecast from this Federal Reserve just yesterday. That was the former Kansas City Fed President, Esther George. She's seen it all. She's been on the dissenting side of things, and she's seen a lot of those forecasts that looked a little like what we saw yesterday.
You know, she said something interesting. If you dissent and the rest of the committee votes against you, it doesn't mean that your view didn't count. People hear it, and I wonder how much they heard Stephen Myron's vote, even if it was very different from their own.
Pushing for 50, and let's be clear, we did think other people might join him, and they didn't. Governor Waller, Governor Bowman. Didn't happen, but there was a credible case for some people, at least, to make that case.
Yeah, especially before retail sales. And once retail sales came in, maybe not. I will say, I don't know how much consolidation there is around a view of 125 basis points of rate cuts by the end of this year. But nonetheless, that is the dot that we saw.
Yeah, I was talking more about the dissent for 50 than I was the dot itself.
But maybe that's the reason why there wasn't as much.
I said earlier this morning, stranger things have happened.
Yeah, it's true.
The Fed's been very offside at turning points. And if you look at the forecast, my favourite is the SEP from the end of 21. Not that I have a favourite SEP, but that's really sad. If you go to the end of 21 and look at their forecast for the end of 22, they're hundreds and hundreds of basis points off where they ended up. They were looking for 0.9%.
The point here, and I think it is very well taken, it is nice to have contrarian views, and sometimes it's really important to consider alternative scenarios, especially in a time of this much uncertainty.
Equities are higher this morning by 0.7%. What uncertainty? All-time highs potentially at the opening bell, 43 minutes away. With your morning movers, let's cross over to Yahira for more. Hey, Yahira.
Hi, John. We are seeing Intel shares absolutely soaring here in the pre-market, up 30%, because as President Trump just said moments ago, it feels like Jensen Huang is taking over the world. NVIDIA is investing $5 billion into Intel, and the rivals will now team up to co-develop chips for PCs and for data centers. And looking at the big picture, it comes after the U.S. government took a 10% stake in Intel, all while China continues to crack down on NVIDIA and prop up its own domestic chip industry. So this just all feels like a bigger chess game being played. And sticking with tech and China, we are seeing shares of Alphabet up more than 1% on a report that Beijing is scrapping its antitrust probe into Android, and the timing does not feel like an accident. It comes just a day before Presidents Trump and Xi Jinping are set to call. So this is being viewed as sort of an olive branch ahead of that highly consequential call. And we end on the consumer with Darden Restaurants down 8%. This is the company behind Olive Garden and Longhorn Steakhouse. Shares are falling after adjusted earnings per share came in below estimates in the latest quarter. And that is because the company, which caters to middle-income consumers, said that it was going to try to limit price hikes to keep diners coming through the door. So that is hitting profits, and its comparable sales outlook did not look good either. John?
Yahira, thank you. Appreciate it. More conflicting signals coming from corporate America.
Yeah, maybe just bad breadsticks. That's what I thought.
Yeah, they've got their own problems.
Yeah, I mean, I'm not
totally
saying
agree with you.
bad,
I know you're kind of joking, but you're not far off.
I just wonder how much this is consumers being choosier, choiceful, whatever word you want to say, picky, and choosing the ones they like and prioritizing that. And this is really a competitive thing more than it is an economic thing.
Let's cut you down to the opening bell. Let's move on from there. Stocks hovering near all-time highs. Equities up by 0.7% on the S&P 500. Adam Hetts of Janus Henderson writing the following: with so many cuts already priced in, if there is a proper growth scare, there is risk that additional cuts won't mitigate the downside. Adam joins us now for more. Adam, welcome to the programme.
Good morning.
That's a really thoughtful statement. I want to give you some time just to build on that a little bit. Are you suggesting that the rate cuts that are already priced, that haven't yet been delivered, are already starting to influence the economy?
There are high expectations right now for more rate cuts, and yesterday helped to affirm that. So the Fed's doing a really good job right now of balancing a wide range of good risks and bad risks, and we think investors should do the same. And portfolios should be balanced right now, which means more of like a 60-40 starting point, and a 60-40 should stay around 60-40. Even though that feels a little bit neutral at the top level, it's not under the hood. If we're talking about a base case of rate cuts with a resilient economy, it's great for growth, it's great for cyclicals, small and mid, it's great for REITs, it's great for international, and that broadening trade should have some room to run.
Why does the bond piece perform in the way you think it should in an environment like this one, when the Federal Reserve is really losing some credibility about its pursuit of 2% on the inflation side? And it's also telling us basically they're willing to underpin the labour market and they're willing to sacrifice things on inflation.
Within that 60-40, that bond piece, right now rates are rallying, and we think investors should extend duration if they haven't already. And if those lower yields across the curve are forcing more of a search for yield in some multi-asset income portfolios, that's where you can look outside the core into the more of the credit, non-investment grade segments. Investors are seeing corporate spreads at all-time tights, nearly that, at least the tightest since the late 90s. This is where you can look outside traditional corporates into securitized. Janus Henderson is a world-class securitized team. We're the second largest active ETF provider with a lot of great securitized offerings there. And we're seeing that go from more of a diversifier to more of a strategic long-term piece of portfolios within the fixed income.
I guess I don't understand why the rate cutting cycle this time around would give such a boom to bonds, given the ongoing strength in the economy and, to John's point, the inflationary pressures where inflation still hasn't gotten down to 2% for more than 4 years. I just wonder, given the fact that equity valuations, yes, they are elevated, but you're looking at the moonshot in AI, you're looking at profitability other than Darden that has been going up, and you look at the idea that there is a lot of cash that is, I don't want to say on the sidelines, because I don't like that expression, but in money market funds. Why aren't stocks the much better choice right now than bonds?
Well, you're seeing those balanced risks play out, and this goes back to why you'd want to keep more of that 60-40 baseline intact. So part of the concerns here and part of the bearish case is price levels are so high. That goes for valuations, top decile valuations in the S&P. You've got credit spreads near all-time tights. But those high price levels also feed into that bullish case about loose financial conditions, especially once you factor in lower rates in the 10-year and lower vol. So those bearish concerns about price levels also feed in and perpetuate that bullish case, which is why you don't want to be underweight equities right now.
How hard is it to convince customers, clients of yours, that bonds still deserve the same place in the portfolio?
This has been a long-term discussion. We get those questions every day, and this goes back to a decade ago, living through that ultra-low rate environment. That's not where we are right now. When you're looking at bond portfolios, you're looking at flexible, diversified bond portfolios, you're seeing yields still in the mid-single digits. And so that is a great cushion. And in that bad case scenario of rates going higher, there is still a small chance it could be from deficit fiscal concerns with global yield ceilings raising. But right now, if we see the yields go from 4 and you blink and yields hit 450 on the 10-year, right now, if you look at Fed projections, you look at the GDP nowcast with US GDP around 3.4%. Right now, if you're seeing yields rise, that actually could be good for risk assets, and that it might hurt your bond portfolio, but that's great for risk assets because the economy is recovering. So if you have the opposite effect and rates rally from here, that still makes bonds a great diversifier for a portfolio, and you're clipping mid-single digit yields.
Adam, what are you actually expecting for next year? Are you expecting a re-acceleration in growth? Is that the base case?
The base case here is you have to expect, if you're looking at the Fed projections, you're looking at broader consensus, you're having rate cuts into this soft landing kind of resilient growth scenario. There's a wide range of risks around it, but it goes back to that broadening trade. We're seeing a lot of opportunities in the SMID caps, in the cyclicals and international, and valuations have crept up, and you've seen that broadening trade work so far this year. But there's a lot of room to re-rate, and there's a lot of room for earnings expectations to go up from where they are.
Which is why we've seen this big outperformance in smalls, at least over the past, what is it, Bramo? 6 weeks, 7 weeks?
Yeah, what did Alex Altmann say? The market
$3 trillion.
cap, $3 trillion. He said, that's smaller than a lot of the mega tech companies in the United States. So hard to really call this a rotation. But it does speak to the idea that there are companies that have been left behind by these all-time highs that we keep talking about every day.
I think he was more comfortable with the word broadening. It's a broadening, not a full rotation.
I think the equal weight is the story that people keep turning to, right? The other 493, and at what point did they outperform given the moonshot of the Magnificent Seven? I just wonder, again, how consistent it is that bonds act as that diversifier. And I think it's really interesting to hear Adam's point, which is it's controversial, and yet the 60-40 coming back as a pitch and just sort of acting as that ballast.
We talked about this. The good news of the last 2 weeks through September is yields on 30s aren't at 5%, they're at 470. 10s aren't at 450, they're closer to 4. That's quite a change. Coming into September, that's not the conversation people were having. In fact, on the fixed income side, there was a real concern. We see a repeat of last year. Federal Reserve would lean into easing, and you'd see a sell-off at the long end. That's not developed this time.
No, and there doesn't seem to be a real significant rise in inflation expectations when you look at break-even rates either. So it seems like people still have faith that the Fed will ultimately rein in inflation should it get too hot, even if it is running above 2%.
Adam, enjoyed this. It's good to see you. Thanks for dropping by. Appreciate it. And for tolerating us. Adam Hetts, of Janus Henderson. We appreciate that too. Coming up tomorrow, Marissa Adams of HSBC, the former St. Louis Fed President Jim Bullard, Congressman Jason Smith, Nadia Lovell of UBS. What a week so far. One more trading day still to go. Going into the weekend, with equity futures on the S&P 500 up by 0.6%, all-time highs just around the corner. We're almost there, Bramo.
You just said going into the weekend?
Yeah, like one more day after this, one more trading day after this.
Why are you teasing me?
Not there yet.
I know, well, maybe.
When we wake up Friday, we'll have record highs and,
Yeah, we're practicing right now.
I'm wishing it forward.
Thank you.